session, so we could see some pullback there. The Broadcom read across is interesting as well.
Yeah.
We'll consider that, but it's difficult to draw links between the AI story in the US and Europe sometimes.
You also got to remember that Europe finished kind of post-CPI and pre-Fed. And the equity market started to, as the afternoon progressed, we dipped a bit. We didn't dip significantly, but we dipped a little bit. So you've got to factor that into your thinking as well.
Yeah, absolutely. So waiting for these European equity markets to open up. A decent day, a strong day yesterday for equities in Europe. So where does that leave us at the start of today's session? Expecting a little bit of pullback is the answer there. The FTSE 100 is open, just drifts a little lower, 1/10% down. The rest of the markets still waking up. The DAX is down 0.2%. The CAC 40, as I say, has been its own beast over the last few days because of the politics, ever since selling off really quite heavily on Monday and then recouping some of those losses just yesterday. The CAC 40 still not open, in fact. There we go, just down 0.1%. So normalization perhaps around that stock story over in Paris, and not much underperformance yet on the FTSE 100.
AstraZeneca, biggest component part of the FTSE 100, is the leading points gainer on the stock 600 this morning, so that's going to give some upside. SAP's having a good day. Do you know what? Shell is up.
Shell is up, and that was to the point that Joe was making. You know, there was the Shell-specific story, and then there was the broader move in oil prices, which we flagged, which could have been in conflict with each other.
The energy sector doesn't look like it's leading the losses. What is interesting is that ASML is actually softer this morning, despite the fact that we've seen some quite positive news coming out of Broadcom. But there is this kind of broader chips narrative, the US taking a much more hostile approach now, increasingly more hostile approach, and then you fold in maybe the EV story to that narrative as well. That may be less good for the chip sector broadly, so ASML softens up a little bit. Siemens is coming down a little bit as well. So I'm looking at this and struggling. Luxury's bouncing back a little bit, tech's down a little bit. SAP's up, though.
Yeah.
It's a mix now. There's nothing here, I think, that kind of gives us a clear steer that is different to what we learned yesterday. Good CPI for markets. Fed tinges that a little bit. US equity markets roll off in the afternoon just a touch. We priced that in this morning. Is that about as far as we can go here?
Yeah, I mean, the real estate story, you know, we are seeing that as the worst performing sector, and that was the best performing yesterday. So to your point that we just unwind some of yesterday's gains. Interesting news coming through from the bond market. EU bonds falling after MSCI excludes debt from sovereign indexes. This is something we've talked about a number of times with some guests about the extent to which MSCI and others are going to include, take to their heart and include those pan-European bonds across Europe. So we'll keep an eye on that one.
Yeah. And exclude sounds like a very strong word there, but it just feels like this has a certain inevitability about it. It's just how long it takes maybe to ultimately get to that point. Europe increasingly feels like it's going in that direction. It's a kind of chicken and egg scenario, isn't it? If you include them, there's a greater emphasis to do it. Yeah. But there's quite a big emphasis to do it anyway. So
maybe a story still in progress, but for the moment, that is where we are on it. So that's where we are on the bond market story this morning. That's where we are on stocks this morning. We are a little bit weaker, is the answer, down 0.3% on the stock 600. In terms of the bigger picture macro story, we had a lot to deal with yesterday with the inflation print and, of course, the Fed later on. Thinking about the Fed and how it deals with those inflation numbers, of course, a lot of the questioning and the commentary from Jerome Powell yesterday focused on the progress that had been made on inflation and what is still left to achieve. Let's listen in to what Jerome Powell had to say on the inflation side.
Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
Let's get more on this conversation. Virginie Masseneuf joins us, Global CIO of Equities at Allianz Global Investors. Virginie, nice to have you with us, as always, on this programme. And you come on a day after much excitement in markets over the CPI and then, of course, the Fed. Did you take away anything new? Did you get confirmation of a previous view, or did your views change?
Not really. We've been in the camp of higher for longer, for a long time. I think what yesterday did is give a bit of more visibility to the market in terms of clearly the Fed's dual mandate, still focusing mostly on inflation, but a few times mentioned the employment situation, which, as we know, has deteriorated a tiny bit. We also know the economy is slowing down. very slightly. So it's more visibility and data dependent, but at least it anchors, I think, the market.
Do you think then that the conversation, well, do stocks continue to not dwell too much on the Fed's dots and focus instead on the progress that's been made on inflation and the earnings stories? Is that where the equity market focus remains?
I think that's where it is, but I also think there's another trend. Now, if you have a bit more visibility in this area, it's the focus on the political cycle versus the economic cycle. And I think that's going to be very important, as you've seen in France. But of course, entering the US election, I think that's going to be a big story. So earnings, you really want in your portfolio strong earnings. I still like tech. I like the enablers, for example, the second wave, right? But you have to be very careful because you'll have that volatility around political cycle or news, right?
Virginie, hello from Frankfurt. We were just talking to Gina Martin-Adams earlier in the show, talking about margin expansion. I'm curious where the margin pressure may actually come from. Is it a concern around demand, a concern around labor, as you mentioned, a concern around supply side costs? Where's the biggest risk for margin pressure?
So for margin pressure, it's all about the transition to a slower inflation and price elasticity, if you want, right? So if you're in an environment where inflation comes down, but where demand is hurt because you have reached a certain level of pricing, and remember, we've been in that environment where companies could just increase prices and have top-line revenues, I think that's going to be the area. It's the price elasticity. So depending on the products, you'll have more or less impact, but I think we should watch that very carefully.
So, Virginie, what does a red flag look like then to you when it comes to cracks in this equity market? What would you look at and say, this is a problem, let's sell?
I think you have to go back to valuation, your confidence in earnings. And for us as long-term investors, it's not so much about the next quarterly earning. However, the next quarter earning, if it disappoints in a framework where you're positive on the long term, will provide a buying opportunity. But I think that's what you have to do. You have to test your conviction on why you want to have the companies that you have in the portfolio. And you have to focus very carefully on portfolio construction. As we know, geopolitics and political cycles are very difficult for markets or for investors to anticipate. What risk premium do you put on it? What spreads should you have on French bonds versus German bonds, right? Yep. Given what's happening. But at the same time, if you have a very clear picture of the fundamentals of the companies you want to own, you use that as an entry point.
Diversified portfolios continue to significantly underperform the S&P. Is that a price worth paying to hedge some of the uncertainty and the growing political risk that you're referencing?
I think it depends what you mean by diversified portfolios. Okay.
Most portfolios are underperforming the S&P. NVIDIA is a huge portion of it.
I know.
I know.
But if you look at certain strategies, such as multi-factor strategies, for example, they've done really well, actually.
Outperform the S&P?
On a global basis. I'm talking about global basis, right?
So on not outperforming basis, the S&P?
No, on a global basis. So if you look at Acquis or you look at global, which, clearly you could decide to focus only on the US. But in a global framework, the impact of those large companies is lower. Of course, if you're under the constraints of 10% max, in one stock, that's it, right? But we've seen that through cycles. But on a global basis, you have absolutely scope to outperform.
Virginie, you talk about AI in your notes. You talk about AI transforming manufacturing. I keep asking people about this. I'm wondering about the timescales involved here and the magnitude of that trend. Is it going to be something that really does show up at the macro level?
I think it will take time. But I think it's definitely in progress. So the way I think about it is we're in the plumbing phase of AI. We're probably halfway through the plumbing phase. After that, you'll see an acceleration of the impact. And, in the note, we talk with my analyst, Romain, we talk about, for example, target agriculture, where you could have a much lower intensity of herbicides, for example, by as much as 80%, if you have AI and data and science. So it's bringing this to a new level.
And does this stand out versus other tech trends we've known and loved in the past? For example, the Internet of Things. You mentioned that as well. That was much hyped, and then did it really deliver? Apart from lots of doorbells and fridges with technology in them these days.
Yeah, it took a long time, and I think what's different between tech and industrials, and this is why this topic is very interesting, is industrials tends to have trades. You know, they organize around trade, so you don't have one big data lake for all industrials, right? But you can see how, if you think of industrials that are data center related, automation related, etc., you are seeing the progress. It's just to look at it from an overall industrial sector, it's a little bit more difficult. But yeah, absolutely.
Virginie, there's this kind of narrative around, unstoppable narrative around this AI story. And I'm curious what happens, if we can play doomsday for a moment, what happens when that liquidity, for example, is redirected in the case of another black swan event, poor economic data, a recession, whatever that may be? It feels like right now, because of all the liquidity and investment going into AI, doesn't that make it even more susceptible to some sort of slowdown, to some sort of economic pullback?
Yeah, so this is, of course, the question we have to ask ourselves. And this is a thing that's difficult with super trends, mega trends, because we tend to think as investors within the cycles of the earnings that the companies we invest in are in. In this case, you really have a transformative cycle. However, you want to be very mindful of what is expected and reflect, in the price versus the earnings delivery. And this is where I think going to the second wave, if you think of technology as the digital Darwinism trend that it is, you want to get into the second wave of the impact because it is propagating. So if you go back to the plumbing, example that I was talking about, if you think that we're halfway through the initial phase of plumbing, very rapidly, you will see the impact. And the impact might not be to buy only a chip company or a manufacturing equipment company. Maybe the impact would be to buy a traditional company who will benefit and increase productivity or will survive from the use or better use of technology or AI.
Do I avoid French stocks until I know what's happening in France?
Well, there's a few things. The first one is, of course, the tariffs are really interesting, the European tariffs, right? And what is the retaliation aspect? So China has 4 weeks to actually come back. As you know, Germany and Sweden and Hungary are against those tariffs, right? But at the same time, there'll be some level of retaliation. In terms of the French election, of course, that is creating some volatility. That is what I was talking about, political cycle versus economic cycle. So in my opinion, if you don't have a full portfolio in France, you might have buying opportunities over the next few weeks.
Okay. We're going to watch the space carefully, as is Virginie Maisonneuve, Global CIO of Equities at Allianz Global Investors. Thank you very much indeed. Let's talk about some of those single stocks. Are there any out there this morning that we should be focusing on? Let's find out. Joe Easton, over to you.
So we're starting with an absolute shocker for Wise at the open. It's down 21%. Now, traders were calling this stock higher at the open, but clearly people are pushing it lower. Now, I've just read the Jefferies take on this, and they're saying that while they did beat expectations comfortably on the last quarter, the 2025 guidance is really bad. It's lower than expected in terms of profit, partly due to the fact that TransferWise will be cutting costs, cutting prices for consumers in terms of trying to boost the demand, and that is why their margins and profits are going to come down as they reduce prices in 2025. So we're down almost 22% on that one at the moment. A couple of other earnings stocks on the screen. Peel Hunt, the UK broker, weakness in the UK capital market does continue for them in terms of their report today. We've got Stellantis out as well. A brief update from the car maker, the maker of Jeep and Fiat. Now, the company is saying that potentially their cost cutting is actually coming to an end at the moment. Slight weakness there. Down the bottom, LPP over in Poland is the fashion retailer, a bit of an ASOS rival, and they are reporting some disappointing sales. So that one down almost 4% at the moment. Then we're going to look at property in the UK. Lots going on today. Firstly, Crest Nicholson, we got a warning out of them. They are saying that it's only the lower cost houses that are doing well at the moment. The higher cost houses aren't selling as much as they would like, so they are cutting their guidance, and that is a big decline today. We also had the RICS price index, and that is showing weakening demand from buyers. And also Great Portland is doing a bit of a share place in that one, coming up around 1%. Quick look at chips after the Broadcom update. Broadcom set to add around 100 billion to its market cap. A bit of a mixed reaction on that one. The chip machinery stocks marginally higher. BE Semi up almost 2%, but not a huge reaction in those ones. I want to look at airlines because there is weakness in that sector. Now, this is not ex-dividends. It is genuine moves lower. Lufthansa is down 4%. Our reporter is trying to find out exactly why. We have got numbers out of Frankfurt Airport today and a couple of other smaller airports reporting. I don't think that is the key reason, but we're going to dig into that because clearly airlines are weakening despite oil being slightly lower today. Just one morning call, and we're looking at Ericsson. Nordea is cutting this one following a weakness in some of their contracts. There's Nordea cutting Ericsson. Ericsson falling at 1.8%. Nordea goes hold following Ericsson's weaker than expected earnings. That one declining in Stockholm this morning.
Thanks very much, Joe. Joe Easton with a rundown of the things on the move this morning from an equities perspective. Thank you very much for that. Coming up, we are live at the Founders Forum, where Tom McKenzie is standing by to talk all things tech for us. Tom, what do you have in store?
Anna, good morning. Coming up, we're going to have an exclusive conversation with the CEO of Just Eat Takeaway. The stock is down 90% from its record highs in 2020. We're going to be speaking to him about what he plans to do to turn that story around, what the AI play is for the company, and whether they still plan to spin off Grubhub in the US. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Thursday the 13th. Good morning, everybody. As we were just hearing from Tom McKenzie, the Founders Forum is underway. It takes place in Oxfordshire. It's an annual gathering of the world's top tech entrepreneurs and seasoned investors, CEOs, government leaders, etc., etc. Tom McKenzie's there as well, which is really important.
Yeah.
And he joins us now. Tom, over to you.
Guy Johnson, thank you very much indeed. Yeah, it is a gathering. It's a really important gathering, Founders Forum. It's relatively exclusive as well, but you do have some of those key founders, entrepreneurs. You've got the likes of HSBC as well here on the ground, Goldman Sachs, Accel, Sequoia, the VCs, the funding is there as well, along with the partners and the entrepreneurs. Right now, joined by the CEO of Just Eat Takeaway, of course, a listed company with that exposure in the US, here in Europe, a gauge on the health of the consumer, Guy, which I know you're interested in as well. So let's bring in at this point Jitse Groen, the CEO of Just Eat Takeaway. Jitse, thanks for joining us. Talk to us about what demand is looking like. This is a business that did so well during the pandemic. It struggled. The stock is down 90% since the peaks in 2020. What is demand looking like right now, regionally, Europe versus the US?
Well, I need to split, of course, the stock performance with how the business is actually doing. In Europe, actually, if you look at the consumers, our consumer base is growing, so I think that's a healthy sign. But obviously, we deal with a sector that is under a lot of duress because, you know, restaurant prices have been going up quite significantly after the pandemic. So food, just in general, has become more expensive. And we see that actually in the behavior of our customers. We have more customers, but what they do, you know, they used to be ordering McDonald's, pizza, kebab, a salad, a coffee, etc. And now they might skip the coffee. I don't think it's unhealthy. I think it's a logical reaction of our customer base. But that's what we see. And this is also why our companies actually focus on creating a lot of value for the customers in the sense of, you know, deals, lower delivery fees, because that's what we control, the delivery fees, of course, and loyalty programs.
What's the margin hit then as a result of that?
No, actually, our margin is going up, ironically, because obviously we charge a commission over the revenue. So actually, the revenue in Europe is going up. It's not going down, but you do see the consumer actually is making a choice for sometimes skipping a more luxury sort of delivery.
And where is the market? Where is the consumer looking healthiest to you, or most challenged regionally?
For our company, but we're mostly in Europe. Actually, in Europe, they look quite healthy to us. I don't think there's a tremendous difference in the behavior. What we have seen during the pandemic, obviously, is a huge increase of the inventory on our website. We used to start with having only pizzerias. Now we have everything, literally. We're even moving into groceries, adjacencies as well. So the choice is larger. And when the choice is larger, actually our consumers are more compelled to return to the website.
Talk to us about the US business. You have Grubhub. The market share has been falling for you in the US. There's a bill that's going to be going through in New York which could remove the cap.
Yeah.
And that could be important in terms of the upside for you. Do you expect that to come through, and what would it mean for revenues?
Well, we've been expecting it to go through for the last 2 years. So to remind people, we have fee caps in New York. They actually started coming in at the beginning of the pandemic, which made sense to us, right? I mean, restaurants were closed by the government. Unlike in Europe, the government wasn't compensating the restaurants, so they asked us to compensate for the closures of the restaurants, which we accepted. After the pandemic, the only thing that happened is that they scratched the emergency law out of the amendment, and we said, well, actually, you don't really have a good reason to, go ahead.
No, in terms of revenues, though, they removed the cap.
They removed the cap.
You could expand the pricing. What would it mean in terms of on the revenue front and for that business?
About $100 million a year.
$100 million a year if they remove it. Okay,
Yes.
that's significant. Are you still planning to spin off Grubhub? Is that still part of the plan?
Yeah, it is for sale, yeah.
It's for sale. Yeah. It's for sale. You've done the partnership with Amazon. They have an 18% stake in Grubhub.
No, they have warrants, so they can get up to 18%.
They can get up to 18%. They have the option to get up to 18%. Some have suggested that makes it more difficult to sell Grubhub.
No, because I need to remind people, look, we're missing $100 million in firepower in the US. So we should not be surprised that we lose market share as a result of that, because we have less marketing budget. In return of a marketing budget, we created the deal with Amazon to supply us with new customers. So that's actually helping Grubhub keep up the level that they are in. And don't forget, Grubhub is bigger than before the pandemic. Obviously, it lost market share, but it's actually bigger than before the pandemic.
Okay. When it comes to the business model, there have been adjustments. So, for example, here in the UK, you were hiring employers as contractors, and you were quite vocal about it. You said this is good for workers, it's good for society, but you've changed that. You've had to lay off a number of staff, 1,700, and you're back to this gig economy model. Do you worry that a Labour government in the UK would punish you for that? They are going to take a tougher line on that kind of hiring.
I would completely support Labour doing that, actually.
You would support?
Yeah, look, our problem is a level playing field. It's not that we have some principled opinion about how to do business in a country. If a country says, all couriers are employees, they are employees for us. We're not going to make a fuss about it. If the country says, no, they're freelancers, they're freelancers. It's up to the local government.
Okay, so it's the level playing field that you're looking for. Before we let you go, it's a big year, sporting year. We've got the Euros, we've got the Olympics. Is that likely to be a boost?
A bit of a boost. We obviously are a big football sponsor in the terms of the Champions League, not for the Euros, but obviously it's a big boost, especially because it's in Europe. So it's actually at our peak hour. And obviously, if it's being played in other parts of the world, it might be in the morning, so we see very little benefit. But we do expect a benefit.
Okay. I do have time for one more. So you have this partnership with Amazon. It's a significant deal. Are you looking for other partnerships like that?
Obviously. I think, look, one of the big benefits that we have is that we are a very large consumer business. Here in the UK, 35% of the population orders with us. So that also means you can tie other things to, your giant user base that you have by giving, and I talked about, for instance, loyalty. I talked about giving them some benefit. So we are in a position to give customers a benefit by working together with other partners. Amazon is one of them, and you should expect more of those.
Okay, Jitse Groen, really appreciate it. CEO of Just Eat Takeaway. Grubhub still for sale. Guys, back to you.
Thank you very much, Tom. Tom McKenzie breaking some news for us there at the Founders Forum with Just Eat Takeaway. Talking about losing market share, but bigger than pre-COVID. Interesting conversation on the consumer and evolving trends. Back to markets, Guy. Stocks down by 0.3%. Interesting that the auto sector for a second day under pressure here in Europe. Chinese autos, EV makers, I noticed, were on the rise earlier on because the news out of the EU seemed to meet many people's expectations yesterday.
It was interesting. We were talking to Virginie a little bit earlier on. Her expectation is that we are going to see some sort of reciprocal relationship being put in force by the Chinese. We've got 4 weeks until we find out what that's going to look like. That seems fairly logical. We'll see exactly what that picture looks like. Gina Martin-Adams is over here, as is Laurie Heinel. She's going to be joining us from State Street Global Advisors next. We'll get her take on the Fed and much, much more. That's coming up. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. We do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We see today's report as progress and as, building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time. And we have to deal with that uncertainty around data. The policy is restrictive and is having the effects that we would hope for. We think we're getting the things that we would want to get, broadly speaking. Rate cuts that might have taken place this year, take place next year. We'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks. Really, the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions.
Rate cuts deferred, I think, is probably kind of where we are now. They're pushing them into next year. We're going to get one this year, according to the dot plots, but with data dependent. So, to be honest, who knows? Let's talk more about kind of how you should be thinking about this in terms of portfolios, kind of what it means for markets. Fantastic to be joined by Laurie Heinel, Global CIO at State Street Global Advisors, here on set, joining us in London. Good morning. Nice to see you.
Good morning. Nice to see you.
Did anything change yesterday? Did the CPI number change anything? Did Powell change anything for you yesterday?
Well, look, I think that there's been this drumbeat that they're going to remain data dependent. The data continues to make progress. They continue to be on a path towards easing rates rather than hiking rates. The question is just really when. At what point does the data underscore their willingness to be able to make that first cut?
Stocks seem to have been remarkably independent, though, of Fed rate cuts this year. We started with 7. And we thought that we didn't get, and that was great for stocks. We didn't get 7, we're not going to get 7, and yet that's great for stocks as well. What is the relation? How are you thinking about the relationship between the stock market performance and what on earth is coming out of the Fed?
I think that's been the biggest surprise for 2024. Coming into the year, we were a little bit more sanguine on what we thought equity markets were going to do. And part of that was because we thought rates were relatively restrictive. And yet you've seen really good momentum in the economy, and actually economies globally starting to bottom out. So I think the stock market is actually reflecting good underlying fundamentals and the fact that there is growth in earnings.
Laurie, can you talk to us a little about the relationship between those rates and the stock market? I think there was a lot of fear even just 3 months ago about what 5% on the 10-year might actually do to the overall stock market in the States. Are you watching certain levels in the bond market right now?
Well, certainly we are watching it through the mechanism of what's the discount rate that gets applied to those forward earnings, right? And so you are actually seeing vulnerability in some sectors like utilities that are a little bit more interest rate dependent, if you will, from a comparative standpoint. But when you're talking about quality growth stocks that continue to have earnings growth that's really outpacing those rates, the discount rate just isn't as critical to them. And I think the market has just gotten comfortable that we may have to live with a little higher rate environment for a bit longer. But importantly, the signaling that the next move is lower is also something the market really likes.
Are buybacks, dividends going to be a factor or a feature of the next couple of years, or is this really a 2024 story that we're seeing on both sides of the Atlantic?
Well, buybacks have been a story for quite a long time, and one would actually argue that the de-equitization of the equity market is also part of what's underpinning this sort of buy trade, if you will. And that's going to be something that companies will continue to assess, because there is a fair amount of cash still sitting out there, particularly in certain sectors. And if they're, looking at a situation where perhaps they're reticent to make a lot of capital investments because growth, while it's coming in, it's not coming in super strong. Buybacks are another way to really buoy those earnings per share.
Laurie, how do you look at political risk right now? Because from a US perspective, watching Europe at this point, but then being mindful of the political calendar and the fact we'll move on to a US election shortly. So does this have an impact on asset allocation geographically?
Well, I think that, the biggest surprise has been that there's not more volatility signaling in the market, given that, as you note, we've got this incredible geopolitical risk. And you cited the elections, but we also still have two wars, two conflicts going on. And yet the market has been really shrugging that off. And so we've been doing a lot of work around, why is that? And we think part of what's happening is that investors have become accustomed to the fact that it's just too hard to predict those things. So the one thing that I would say is that we're seeing less conviction in bets. So you have lots of camps that are, we think markets are going higher, lots that are, we think markets are going lower, but not a lot of high conviction trade. And so that's keeping people a little bit close to home.
We spoke to a guest earlier who was saying that part of the reason might be that inflation has proven to give pricing power to a lot of companies. And that has meant that margins have been maintained. Is that going to be key?
Well, certainly pricing power is one part of the equation. You also do have leveling off in commodities prices, so that's helping a lot of industries. And then again, don't forget, we've got industries and sectors that are just growing very, very rapidly. Their fiscal stimulus in the U.S. and in Europe has actually buoyed that, particularly in the U.S. So there are a lot of different dynamics that are actually playing into this.
The equity markets remain very concentrated. They get more concentrated, it seems, by the day. How does the rest of the market pick up the slack? When do we see this broadening out that we seem to have been talking about all year, but is yet to really happen? Does that happen? How critical is it that it does happen? And what drives it, do you think?
Well, eventually it does have to happen, because there's only so much that a few stocks can actually drive. And what it's going to take is it's going to take broadening out of the economic growth picture, right? And so if you look globally, there are signs that we are seeing a bottoming out outside the U.S. in particular. And we are seeing broadening out in things like industrials, where we actually think that there's some reshoring that's going into play there. And broadly, just getting...
You're confident that's going to happen? Because the market, it hasn't happened yet.
It hasn't happened yet.
And I keep thinking, what is going to be the catalyst for it? And I keep thinking, yes, the economy's broadening out. Yes, the economy continues to do well. In theory, this should be great for that broader picture. But yet the market gets more concentrated.
And here again, it's getting confirmation that you're actually getting growth globally, that's actually ticking up. Yeah. And then also ultimately easing financial conditions, right? Because one of the realities is that these high rates are hurting in many sectors, especially when you look at small businesses, especially when you look at certain property markets, things of that nature. So you got to get a little bit of help from the Fed eventually.
And talk to us about, so in this broadening out and where it goes geographically then, Laurie, thinking about emerging markets and the way that a number of central banks, well, we've seen the dollar, of course, benefit from a whole host of things, but a resilient U.S. economy very much this year. Expectation that maybe that has weighed on some emerging market currencies. Does that factor into your thinking, or do you see resilience in emerging markets? There's a lot of political turmoil there, depending on the market as well.
We've been quite cautious in emerging markets for most of the year, although we've recently upgraded our trade in emerging markets, in part because we're finally seeing China get a little bit of traction. I think the reopening trade in China was a bit of a yawn post-COVID, but you're now starting to see some consolidation there. So we're getting a bit more constructive in emerging markets.
How much does the currency story play into your thesis here, Laurie? When we're talking about positioning in the dollar, specifically following the Fed, but also going into the U.S. election, how does that kind of ripple across into some of the assets you're looking at globally?
Certainly, the strong dollar has been one of the reasons that we've been more constructive on U.S. equities as well as U.S. sovereigns. So despite the fact that there is vulnerability here in the rates market, given the Fed continues to hold tight, we actually like U.S. long-duration treasuries. And I think you can't ignore this kind of one place where there is a little bit of a safety factor, right? That flight to quality during geopolitical risk times. And, oh, by the way, yes, we're going to get elections in the U.S., but it's still a little too early to start to put trades on in advance of that, given just how uncertain that outlook is.
You said that you are you're still positive on long duration equities, or long duration bonds, excuse me. Talk to us a little bit about where that fiscal deficit narrative comes. Do you see any sort of repeat of what we saw in the third quarter of last year, where that almost freak out on the U.S. budget? How does that show up?
Well, first of all, it's likely to be more of a slow burn than some sort of a dramatic event. We are concerned about the long-term sustainability of U.S. debt, and particularly given that we're running deficits at times when actually the growth picture is quite good. So there is concern really about that crowding out, that this makes really tough choices for whatever the next administration is. How they manage this deficit trajectory is going to be one of their critical concerns that they'll have.
Laurie, thank you so much for joining us. Come by again when you're in town. Laurie Heinel, Global CIO at State Street Global Advisors. We will be speaking to Richard Clarida, former Fed Vice Chair and PIMCO Global Economic Advisor. That interview will be on The Pulse at 9 a.m. UK time, so another important voice weighing in post-Fed, post the CPI. Coming up on the programme, we'll have an exclusive conversation coming up shortly. The founder of Shelling AI, that is next.
Looking forward to that conversation from the Founders Forum. Plus, we're going to be back out to Bari. The G7 is meeting their world leaders gathering. Looks nice, doesn't it? Palm trees. Fantastic. This is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show. This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Markets Today. We are are 43 minutes into our European trading session, and we're recouping some of the, or rather we are backtracking on some of the gains we made yesterday on European stocks. They will post the CPI pre the Fed, and so post the Fed, we have to factor in a little bit of weakness here for European stocks. So we're down by 0.3% on the stock 600, the FTSE down 0.1% or so. French markets kind of in the mix, which tells you a little bit about the journey we've been on for French stocks since Monday, when they were anything but in the mix. They were certainly telling their own story. Let us get to the technology themes, though, that are dominating the Founders Forum here in the UK this week. Some of the biggest names in technology gathering there for conversations about the future of AI and the like. Let's get to Tom Mackenzie, who joins us now from the event in Oxfordshire.
Anna, thank you very much indeed. It's unseasonably chilly here in bucolic Oxfordshire, but there is that focus. We do have some fantastic entrepreneurs, founders, VCs, funders. It's an exclusive gathering here, and we're very pleased to join now by Emad Mostak, who is and has played a really pioneering role, particularly when it comes to text to image within the AI space. The former CEO of Stability AI, currently the CEO of Shelling AI, and one of the founders as well, originally of Stability. Emad, thanks for joining us. Let's talk about the new venture then. You resigned from Stability AI in March of this year. You've started Shelling AI. What is the proposition? What are you hoping to achieve? What is Shelling AI all about?
Shelling AI is about building properly open source models for education, healthcare, governments, and more, backed by an institutional grade digital asset. So Bitcoin is probably the biggest market fit of Web3. It uses about 4 times the energy of generative AI to secure the store of value. And now you have ETFs there for Bitcoin, Ethereum, and more. One of the problems when building a foundation model company is how do you get exponential compute? And so we realized that we could do that by having an institutional grade digital asset secured by generative AI compute to build this real important infrastructure for society.
Okay, there's a lot to unpack there, and there's a lot of detail, and that's where you go, Emad. I know you're in the weeds on this stuff, but this is a combination of a crypto asset, is what you're looking at, and a foundation model. There will be concern from some around risks around crypto assets, and then you have the competitive nature. So many different foundation models on the market now. How do you address those concerns?
So I think that when we look at open source, we have open weights and things like that from Meta, etc. But governments, education, healthcare will need to have open data sets and culturally aware data sets that represent every single country. This is one of the things I originally was wanting to do at Stability, but it's a complicated thing to build models of all different types. And when you're building foundation models, you have a massive compute expenditure. So when looking at this, I realized we could combine these two because there's demand for digital assets, institutional grade, again, with the ETFs, and there is demand for these governmental education healthcare models where you know all the data that's going in it. Right now we have AI models, we don't know what they're fed. It's like having food without knowing what the ingredients are. And these models can be poisoned. Like Anthropic had this paper called Sleeper Agents. You put a few thousand lines of bad code in there, and the model can turn evil with a word. So I think that this needs to be built to the highest standards. And there's also the models that will judge every legal output, medical output. You can be able to do an opinion without having an AI checking it.
Who's backing you, Emad? Where's the funding coming from?
So we had some of the original funders come in, and there's lots of interest right now. We're just trying to figure out the right structure.
You're fundraising right now?
Well, there's lots of interest.
Okay. Does generative AI have a monetization problem?
I think that most of the monetization right now has happened when you've got distribution, even though it's still a research artifact that hasn't been kind of optimized. Like there were reports in the information yesterday, OpenAI got to $3.4 billion in revenue run rate from just $20 million a couple of years ago. Mid-Journey got up to a couple of $100 million. And I think that the key problem here will be profitability for companies that are building their own models. If you're using someone else's models, then yeah, there are great businesses to be done. And again, I think you'll see hundreds of millions, billions of dollars of businesses being built. But building your own models is very, very hard. In fact, I think Stability was one of the only European companies, apart from Mistral, that built a state-of-the-art generative model of any type.
And it's hard and it's expensive because of the cost of compute. And that leads to the concerns from some, at least, that the US and US big tech is getting a stranglehold on this technology. Do you align with that? Is that a concern that you share?
I think it's like electronic vehicles, actually. The US kind of started there, but now some of the best models are coming out of China because they have more data advantage because they can use copyrighted data. And they have this engineering advantage because models are going from research to engineering artifacts. But there is this concern about what if the only models are from China and the US? And again, this is why news like Mistral's funding, Aleph Alpha's funding is fantastic because we'll have more options.
Okay, but you think China will be a threat?
I think China will have better models than the US. We've already seen it in video and other things because, again, they have a data advantage, scale advantage, and engineering advantage. Two of the fastest supercomputers in the world are in China, Ocean Light and Tianhe 3, and they're not really talked about.
Emad, let's take you back to Stability AI. As I said, really, really consequential in kind of getting the text to video, text to image play into the hands of users and consumers. You still have a majority stake in that business. Look, there's been a lot of reporting around the controversies linked to it. Some former employees telling Bloomberg that it's in a death spiral. Is Stability AI still a going concern? Is it what happened in terms of you leaving, and is it still viable as a business?
So I wanted to build Stability into a multimodal AI company that could compete with the biggest players. That is a very expensive endeavor that required large amounts of compute. Stability AI now is more a media AI company that has far lower costs, and revenue was going up to millions of dollars a month when I was leaving. So I think it's actually got a path to cash flow positive, but it's a different type of business now. And again, my focus was on building the multimodal, larger kind of thing. So I think it's in a good place now. Stable Diffusion 3 just got released yesterday. And ultimately, Stability had 300 million downloads of its models. We overtook Google, everyone. And we built state-of-the-art models not only in image, but everything from protein folding to video to 3D. So I think there's a really good base there. It's just now the new management will find it a good place to go, I think.
Is the new management, there's been reports that they struggled to raise additional funding. Where are they on fundraising? Are they being successful? Are they able to tap those new flows of cash that they need?
I've basically separated completely because I don't want there to be any conflict given the new venture. So I'm a shareholder, but that's it for now. So I've received no additional information on that.
On the question of compete, do you worry of compute, I should say? Do you worry, how much concern is there? What is the debate around NVIDIA's dominant role when it comes to compute? Do we need the Intels and the AMDs to come through and successfully compete? And that gap seems to be years away still.
I think the gap is far smaller than expected. So we did some work when I was at Stability where we took Intel chips and they outperformed NVIDIA chips, but they were almost a third of the price. I think as you move again from research where you need these generalized GPUs to more specific use cases, the 80-90% NVIDIA margin gets eroded because you just care about top performance. This is why Microsoft, Amazon, and others are building their own things. Again, it's like Bitcoin, GPUs to ASICs that we saw. So I think that, again, if you're training your own models and big models, NVIDIA is still good, but I wouldn't be surprised to see a chip glut this time next year, or even sooner, perhaps.
You've had conversations with the government in the past. Post July the 4th, what is your expectation? If we get a Labour government, is that government going to be supportive? Have you had conversations with Labour? Are they going to be as supportive around UK tech? Do you think, as some have said, the current government are? What is your take on the UK as a potential hotspot for this activity?
We had minimal engagement with the government. We just kind of got on with our own thing. And from what we've seen, the Labour government will be supportive with tech as well. Shelling is a UK company, and we hope to make it a success. I think the UK is
What are the biggest challenges for the UK? Is it immigration? Is it visas?
Visas, I think, are fantastic. I think we're here at Founders Forum, and they're leading on Tech Nation, and there's the scale-up visas and more. R&D tax credits could be reverted to what they were, but again, it's fantastic. The biggest challenge for foundational model AI companies is still a lack of regulation on AI and clarity about the data usage and other elements there. So that would be great for that.
You want a stronger regulatory framework in the UK for AI?
A defined regulatory framework. I don't think it shouldn't be unregulated. I think that it needs to be clear as to what you can build, how you can build it. And I think the UK can take a real lead on that.
Does the EU AI Act, is that something that we could emanate here?
I think that one was just too undefined. Like, it asks for interpretability of models, but no one knows how to do that. So let's keep it to really concrete things and just have clarity around these so people can just get on and build.
Okay, Emad Mostak, thank you very much indeed. The CEO, the founder of Shelling AI, the former CEO of Stability AI, on the fortunes of that business, but also how he hopes to push through a new model in terms of AI, diversified as well and linked to the crypto space. Emad Mostak, thank you very much indeed, and there'll be plenty more from Founders Forum throughout the next hour or so. Guys, back to you.
Tom, thank you very much indeed. Really interesting things being said there as well about Chinese strength in engineering and how the supercompute capacity in China maybe is underestimated, and what he said about NVIDIA chips versus the rest of the group. We'll be back to the Founders Forum a little bit later on, as Tom says. We'll get more from that group. Some really good interviews coming up. What else do you need to watch for the rest of the day? Keep an eye on claims out of the United States. PPI data is going to be interesting as well. Williams is going to be speaking. Yellen's going to be speaking. The G7 is underway. We'll take you there in a moment. The Tesla AGM, Musk pay, very much on the docket there. And we'll be back to the Founders Forum.
Yeah, absolutely. Back to the Founders Forum. Tom McKenzie is there all day for us. And Kriti, you're across the G7 story. We need to get an update there.
We do. We should just go straight to Oliver Crook. Of course, he's monitoring this very, very closely, who, of course, is at the G7 in Bari, Italy, really living the Dolce Vita, but also, of course, covering the latest out of there. Ollie, let's go to you. Bring us the latest on those Russian assets. What is the conversation like? Where's the conversation going from here?
Yeah, this is where the conversation at the G7 has really coalesced, is really trying to make meaningful step forward here on what to do with those Russian assets. And we understand that there is now a political agreement, which is sort of where we left the G7 finance ministers, but we're starting to see sort of more clarity on the contours of what that actually looks like. What that will actually look like is the form potentially of a loan that's fronted by the United States, but also other G7 members. There are questions still around what proportion does each country sort of give to that. Those are the kinds of things that they are hashing out. Of course, there's also the other question of, if there is eventually peace with Russia, what happens once those assets thaw? How do you get those sort of forward earnings paid for? Who's on the hook for that? These are all the discussions that are happening right now. I also know that Olaf Scholz has just landed. So these are sort of all the leaders now coming together to have that conversation. But it will also be a conversation not just about Russia, but also the sort of influence of the G7 and sort of that bloc here, which is why they've invited a lot of other countries outside of the G7, whether it's Turkey, whether it's Brazil, Argentina, UAE, to really draw a broader tent in what is an increasingly fragmented world, with the G7 making their pitch.
China, front and centre, it's never far away, is it, in terms of the competition that exists between this group and, you can argue, China. We've just seen the EU imposing auto tariffs. How central is that going to be to this debate as well?
Guy, I think it's central on some very specific points, but also if we take a step back, Guy, the whole sort of G7 premise is underpinned by this idea of peace through trade, right, which has really been the governing foreign policy doctrine for much of the liberal democratic West for many decades, a doctrine that has really been blown to pieces by a number of conflicts that we've seen around the world, and increasingly potentially walking slowly towards, we could see, another trade war, Guy. So there is the question, yes, the EU tariffs are coming in. The real question is, everyone is watching, and I know this from the auto manufacturers with whom I spoke yesterday, what is the Chinese retaliation going to be? Because that is still an open question. They say that they're going to now put their complaint forward to the WTO, but the WTO doesn't really function properly right now, and that is not a very sort of swift mechanism for resolution. So the question is, will there be retaliation? And then that prompts the question, Guy, about these German car companies and all these car companies looking at their global manufacturing footprint. These tariffs are good for a moment for them in terms of competition within Europe, but that'll last only about 3 years. They have warned. I mean, BYD, they're already building factories in Hungary, which is within the EU tariff border, and that is going to be another central question for the Europeans. How do you remain competitive?
And we certainly see some objections to these tariffs, even from within Europe, as you suggest, certainly Germany and other parts of Europe objecting, even if the French are on board. Oliver, thank you very much. Bloomberg's Oliver Crook, who's live at the G7 in Italy for us. Away from the G7 and the politics, market's very focused on the politics, of course, but we do also, Kriti, have a little bit of weakness on European equity markets this morning, post the CPI and post the Fed.
Yeah, it's really interesting what the dynamic's going to be here from the bond market and the equity market here. I'm looking at a 10-year that's still at 431. Do you continue to see that pressure in the bond market reflected in the stock market? What is the relationship between the two assets? That's what I'm going to be watching.
I'm going to be watching a conversation which I'm about to be having with Rich Clarett, a former Fed Vice Chair. We'll be joining Bloomberg in just a moment, PIMCO's Global Economic Advisor. That interview moments away. This is Bloomberg.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Thursday the 13th, good morning. Welcome to The Pulse. I'm Guy Johnson in London. Francine is off today. Let's talk about what we've got coming up for you. The Fed signaling one cut this year, but Jay Powell keeps the door open to a possible second.
The most recent inflation readings have been more favorable than earlier in the year. However, we'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%.
That was, of course, the Fed chair. Wall Street shrugging off Powell's cautious outlook. The S&P hitting yet another record high. More of a focus on the CPI print than maybe the Powell story. European stocks dipping this morning. I'll get back to that in just a moment. Plus, we're live in Italy, the G7 summit beginning. Leaders are set to agree to tap frozen Russian assets. The idea there that they can use that money to fund aid to Ukraine. Let's talk about the markets. Look, today is in some ways just a kind of period of digestion. European equity markets gapped higher on the CPI print yesterday. We continued into the end of the day here in Europe on an upward trajectory, but that was pre-Powell, of course. US equity markets then rolled softer as we got the Powell comments and the maybe more hawkish dot plot, as a result of which we've just factored that extra little bit in this morning. As you can see, a little bit of red across the screen here in Europe, but in aggregate, I think you need to kind of factor in yesterday's session when you think about today's session. In terms of other asset classes, look, S&P futures are doing absolutely nothing. The 10-year is absolutely unchanged right now. Euro dollar is barely budging. Brent crude is down by 0.2%. Again, I think you want to look at yesterday's session for the market reaction to what we have learned from the Fed and the CPI rather than what we're getting today. Today is just a reaction really to yesterday. Everybody's kind of thinking about what they've learned. So let's think more about what we've learned. Let's get some interesting insights into what was delivered yesterday from the perfect person. Rich Clarida, Global Economic Advisor at PIMCO, of course, former Federal Reserve Vice Chair, joins us now from Zurich. Rich, great to see you. Perfect person to talk to. What did you make of yesterday in aggregate?
Well, it was an interesting meeting. Obviously, no rate decision. I think the dots came in on the hawkish side with only one cut penciled in this year versus 3 in March. That's what I thought going into the meeting was more likely. I thought it would be a close call as it was. Obviously, in some ways, the Fed got trumped yesterday by the data. The CPI numbers were very Fed friendly. The core number was soft. Headline was around 0. And so it's interesting that even though you could argue the Fed on net was hawkish, it was on net a dovish day in markets given the CPI report.
Yep. So are the dots old news, given the fact that we've got updated CPI, which is maybe a little bit more benign and positive?
Great question. You know, they could be stale. Now, the chair did acknowledge, as certainly was the case when I was there, that members of the committee do have a chance on the day of the meeting and yesterday after the CPI number came out to revise their dots if they choose to. He didn't want to go into whether or not folks actually had. To the extent they didn't, and certainly if we get more numbers like this, then they could be stale. But I more or less think that right now they are in data-dependent mode. I know it sounds trite, but I think they need to see a lot more good inflation data to have the confidence to cut.
How far through that journey do you think we are, though, Reg? We've talked about, and Chris Wallace talked about this, the need to see a series of data prints that are pointing in the right direction, that take us in the right direction. How big a tick in the box kind of down that road are we, given the CPI data that we got yesterday?
Well, I certainly think we're going to need, they are going to need more data than just the one more set of prints we'll get before the July meeting, which I believe is July 31st. And since there's no meeting in August, I think the soonest practical time to even think about a possible rate cut would be the September meeting. And then my own judgment is a lot would have to go right between then. You know, we'll get numbers for June and July and CPI for August. And so if you had 3 more numbers like what we got yesterday, then September could be possible. But I think barring that, we're probably looking at either November or December. And that's more or less, I think, where market pricing is right now.
I'm assuming December is probably more likely, given the politics that's going to be happening in November.
Yeah.
Would that be correct?
Yeah, indeed. The November meeting, if I look at the calendar correctly, Guy, the November meeting this year is the day after the election, which obviously could make sense if it's a close call to do that in December, yeah.
In terms of how we think of this in aggregate, Rich, the sort of the totality of the cuts, while the cuts come later, seems to be largely intact. We're going to get to the same place. We're just going to take longer to get there. Is that the right way of thinking about this?
Yeah, that was exactly, and indeed the chair more or less made that point yesterday in the press conference. It's fewer cuts this year than they thought in March, but they added an additional cut to 2025 and an additional cut to 2026. So they actually end up, now again, the further out you go in the projections, really the less informative they are. And so you saw the chair yesterday in the press conference sort of remind folks of that point. But yes, if you just take the dots literally, they literally get to the same place they did in March, but just with more of it back loaded. And again, assuming that the inflation data does break their way. Yeah, the other interesting thing about yesterday, when I think he was pressed by a reporter about cutting with inflation running at 2.6 or 2.7%. I think what they had was inflation running at 2.8 by the end of the year. You know, the chair made some reference to that. I don't have the exact quote, but, you know, that would be a pretty good place to be. Now, obviously, the Fed is targeting 2% inflation, but it does reinforce this message we've had at PIMCO for some time, not only for the Fed, but the ECB and the Bank of England and others, that they're really operating in a 2-point-something range on inflation. And once it gets there and they think it's falling, they can begin to cut and cut in tandem with declining inflation.
Is the focus on inflation, the Fed obviously, and you referenced a couple of other central banks there, the Fed has a dual mandate. Is the focus on inflation? Is the balance kind of 60-40 inflation versus what's happening with the labor market? How do you think the kind of the mix of inputs they're thinking about works right now?
That's a great question, because I actually think it's quite important in this cycle. I think it was clear back in 2022 and 3 that when inflation was too darn high, they were, in essence, a single mandate central bank. Even Chair Powell even acknowledged at Jackson Hole in 2022 that raising rates could cause some pain. We haven't seen that. It's been a very, very rapid and so far painless disinflation. And you got a question yesterday about whether or not they would cut rates preemptively because they were forecasting a softening economy and a rise in the unemployment rate. And he didn't commit to doing that. He said they want to try to avoid that. On the other hand, they also want to avoid a situation where they declare mission accomplished and then have to be hiking rates next year because inflation rebounds. And so my guess is that on net, they're going to really need to see some tangible evidence of economic slowing before they would actually cut, absent some better news on inflation.
Rich, the trade that everybody seems to have on is the steepener. Everybody's anticipating we get rate cuts. The fiscal position probably means the back end remains reasonably elevated, and that's the trade that everybody seems to want to have on. Yet we've seen very little movement in the spread 2s, 10s for really quite some time. Well, since the beginning of the year, really. When does that kick off? When does that, if that trade is the right trade, when do you think it starts to really materialize and work?
Really good point, because we obviously have an inverted curve, and we have now for nearly 2 years, so I think that's close to a record. At PIMCO, we don't believe inverted curves are the new normal. The curve will re-steepen, so in that sense, it is the good trade to have on over the next several years. As in anything in financial markets, markets will try to get ahead of the inflection point. So sometimes, it's better to look at those opportunities not so much in spot space, but in forward space. So essentially, the way when our market's pricing them, the curve will steepen, and to try to look for opportunities there. But there's a lot of money on the sidelines right now, for example, in money market mutual funds. And my sense is that once we do get that first cut, or once it more or less gets priced in 100%, you will start to see a lot of moving in the direction of the steepening bias.
Rich, you're in Europe, you're in Zurich. We're watching quite a lot of political consternation here in Europe. And I'm just wondering how you're thinking about how investors, how portfolio managers should be thinking about political risk right now. It suddenly seems to have inserted itself into the debate in a way that it hasn't for a while. We're seeing it in France right now. We've seen it in some emerging markets. We're all looking so carefully at what is going to happen in November in the United States. How are you guys at PIMCO? How are you thinking about kind of trying to navigate that, and what is the best advice you've got, and how are you thinking about what that process is going to look like?
Well, it was a focus of our recent secular forum. We are certainly now moving into a multipolar world. More than 60% of the world GDP is in countries that are having or have had elections this year. We've seen surprises on both sides. A surprise in India, where Modi did not get the support expected. On the other hand, in Mexico, where Sheinbaum got more support than expected. Obviously, an early election in the UK, Macron now indicating elections for the parliament in France, the European Parliament. We could go on for several segments. The way we look at it at PIMCO, guys, that there's always some element of geopolitical risk. But I think you'd have to argue now, given that we have a hot war in Europe and in the Middle East and the geopolitical risk, it just emphasizes that this is a volatile, uncertain world. And what we're doing is trying to put together for our clients robust portfolios that do well in all circumstances. It's a challenge, but I think there are opportunities there.
Rich, I couldn't have thought of a more perfect person to talk to digest and analyze what we got yesterday, CPI, the Fed. A genuine pleasure, sir. Thank you very much indeed. We always appreciate your time. Richard Clarida, Global Economic Advisor at PIMCO, and of course, former Federal Reserve Vice Chair. Thank you very much indeed. Up next, we're going to take you to southern Italy. We're going to take you to Bari. The leaders of the G7 are meeting there. We are watching carefully to see a number of pieces of news evolve, particularly around Russia and the use of assets to support Ukraine. We'll do that in a moment. We'll take you live to Bari. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Thursday the 13th, let's take you to southern Italy. G7 leaders have got a full agenda. They've got a lot to talk about in southern Italy. The key focus, we think, is probably going to be around how we provide aid, how we finance aid for Ukraine, and whether or not we're going to be using $50 billion worth of profits generated from Russian assets that have been seized and frozen, and how those are then used to support Ukraine, and how sustainable that process is, I think, is a key question. Now, there is not a uniform view on this, so it's going to be interesting to see how ultimately this deal comes together. Let's get a sense of kind of where we're going. Let's go to Bari. Let's go to Ollie Crook. He is standing by for us. Ollie, how is this shaping up? What are we expecting to be delivered here?
Yeah, guys, so let's just set it back up and take a step back again. This has been the fundamental debate, what to do with these $300 billion of frozen Russian assets. The United States has advocated in the past seizing those actual assets and sending them directly to Ukraine to fund the war and get really the financial footing that Ukraine needs, not just for this year, but for the many, many potentially years to come. The Europeans have been much more hesitant about seizing the underlying assets, so what they've coalesced around is this agreement of basically issuing a check, cutting a check up front, and then basically repaying that over the years by the profits that is sitting in those central bank assets that are generated every year. Now, we understand the structure of that is changing a little bit, and we understand that there is now an early sort of political agreement that it will take the form of loans that will then be paid off, as those profits are generated through the years. But there's still a lot of technical details to work out, Guy, and we're still working on trying to figure out exactly what those are and where the sticking points are, because for the G7, this is their main deliverable. If they cannot walk away from this with something concrete, this will be really an indictment for the G7 at a time where there's perhaps not great sort of confidence in that group.
Is it about ultimately how Ukraine spends the money? I understand that the EU leaders are a little concerned that ultimately, if they were to guarantee loans, that money would ultimately then be used to support the US defense industry. Because that is largely where the money would be spent, and as a result of which Europe is carrying the risk and the US is taking the benefit. Does it ultimately come down to kind of how the money is used by Ukraine once those guarantees exist?
Yeah, Guy, that's a huge part of the conversation as well, and it sort of begins to usher into sort of all the details that they're needing to work through, right? So that is going to be part of it, is where the money is going to be spent. We really understand that they prefer it to be gone, obviously, to defense. Within that is their sticking point, but obviously also reconstruction going forward, and some of the general financing need that Ukraine is absolutely desperate for. But this is a very wide conversation. I mean, let's not forget these assets are being held in Europe, right? So the Europeans potentially feel that they have a larger claim over them. They don't necessarily want to be more on the hook to have to repay if those assets ultimately thaw, and there's a $50 billion loan that still needs to be repaid. Guy, who's going to pay for that? That is going to be fundamental to working out the technicals of this deal.
Yeah. And what happens a few years down the road if the situation on the ground changes in Ukraine and in Russia? How are the recent EU elections complicating matters? How are events that are unfolding in France potentially complicating matters as well?
Yeah, Guy, I think this is a fundamental issue here, right? This is a sort of lame duck G7, or at least lame duck G6, right, where you have 6 leaders here. I mean, it's been crystallized by the EU elections in the form of Scholz and Macron. Macron's running a sort of full-out election campaign right now. He's sort of dealing with Marine Le Pen, who's sort of nipping at his heels. Olaf Scholz, who just landed just a few moments ago, by the way, is being assailed by the AfD, who this week boycotted Zelensky at the sort of German parliament, basically calling him a begging president and really undermining Scholz and the government's position on Ukraine. So these are sort of how these issues begin to crystallize. But let's not forget, Guy, Rishi Sunak's not winning any popularity prizes, nor Justin Trudeau, nor Kishida in Japan. So this is a very sort of weakened G7 coming together that's really trying to pitch themselves as a sort of the strongest bloc within the global stage.
Yeah, it's interesting. You bring in China, you fold in China to that story as well. Ollie, great coverage. We're going to continue to keep you abreast of what is happening in Bari, in Italy. Any breaking news on some of the events that Ollie has been talking about, we will bring straight to you. So we'll be back with Ollie throughout the day. Coming up, what do we need to focus on? We need to talk as well about another element of the Chinese story, the EU hitting Chinese electric cars with tariffs. We're going to look at what it means for the bloc's trade relationship with China. What does it mean for its automakers? How is China going to respond, I think, is the next piece in this puzzle. We will discuss that next. We'll talk Tesla as well. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
22 minutes past the hour. We're waiting the start of US trading. Broadcom looks like it's going to have a very solid day. Stocks up really nicely pre-market on the back of the numbers delivered last night. Big Apple supplier here. The AI trade certainly working for it right now. So Broadcom's up by 14% pre-market. Another stock I want to mention that's up pre-market as well is Tesla. Looks like that stock is up by circa, let's call it 6.5% pre-market. Let's call it 7% actually, slightly improving on the numbers that I saw just a moment ago. Elon Musk out on the tape. Both Tesla shareholder resolutions passing by wide margins. Wide margins, quote. We are debating, of course, here what Elon's pay package is going to look like going forward. Significant scrutiny of what is happening here. Is he allowed to do that? Is he allowed to come out and say that they're going to pass by wide margins? Let's find out and talk more about what's happening in the car sector. Craig Trudell joins us now to discuss. I raise an eyebrow. Is that okay?
You know, we were talking in the break. It feels like it absolutely reinforces what the criticism of him and his board, has been. The fact that the Delaware judge who tossed his pay package said that his directors are conflicted, that shareholders aren't being sort of protected by this board, and in the course of fighting back against that, we've seen him openly sort of lobby for himself. Him sort of, seemingly get his own people within Tesla to push for his pay package. Putting aside whether you think it's right or wrong that the package was thrown out, a lot of the things that the judge, criticized him and the board for, he only seems to be reinforcing in the last few months.
Let's turn to what's happening with European car makers. Double-edged sword, these EV tariffs on Chinese goods coming into the country. The French seem okay with it. The Germans are clearly very nervous. When do we find out how China's going to respond?
I think the interesting thing for me here is this idea that, China is absolutely going to respond. I would be surprised if they don't do anything in response to the fact that, these tariffs are going up pretty substantially, at least in the case of SAIC, the maker of MG.
Yep.
But I do think that there's a concern about overdoing it here in the sense that the European market is the one market in the world that's buying a lot of EVs and spending, paying quite a bit for them. So, do these hurt these companies, the tariffs on these Chinese manufacturers? Absolutely. But they don't have necessarily a lot of other places to turn. So, do they want to escalate substantially? Maybe not. They may want to sort of be careful in how they respond here so as not to overdo things.
And it's interesting that some of these big Chinese companies are also building production.
They're also localizing, exactly. Yep.
To maybe kind of get around this whole narrative. Craig, thank you very much indeed, as ever. Perfect. Craig Trudell joining us on what's happening in the auto space. Up next, we're going to get the Labour Party manifesto out here in the UK. We'll find out more details about that next. Bronwyn Maddox is going to be joining us from Chatham House to discuss all of that, plus also foreign policy in the UK. Where's that going? This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Thursday the 13th, good morning and welcome to Bloomberg UK. I'm Guy Johnson in London. Francine is off today. Let me run you through a few things that you need to know. Prime Minister Rishi Sunak has taken a pause from the election campaign to attend the G7 meeting. It's being hosted by the Italian Prime Minister, Giorgia Meloni. We're going to come back and talk more about the UK more broadly at the moment, but I want to focus on this because I think it's really important as to what is happening there. We've just had some breaking news, which we've been kind of expecting. We're now starting to get the details on what is actually the reality. It's related to how Russian assets, frozen Russian assets, largely in Europe, are going to be used to fund Ukrainian aid. I want to get back to Bari in southern Italy. Ollie Crook has the details. Ollie, run us through what we've been learning over the last couple of minutes.
Yeah, guys, so this is really sort of important in terms of really hammering down the structure of what this is going to look like, that disbursement of trying to tap those underlying Russian assets, of which there are about 300 billion that are being held right now, mostly in Europe, and dispersing that about $50 billion over to Ukraine. So what we understand and what we've just broken in the last few minutes is that the form that this will take is multiple loans done sort of bilaterally between each of the G7 countries. The EU will be its own bloc, and each of these loans will be then given to Ukraine. And this is the key detail here. The question was, how much will everyone contribute? It's going to be proportional to the size of the economy. And these are sort of the details that we're getting and sort of the nitty-gritty that the G7 leaders have been here to work out. Because, of course, Guy, there's been a political agreement for this for some time. These are the details of how it's going to work. And then eventually those loans that are given by those individual countries and that bloc will be repaid over time by the sort of proceeds from the Russian assets, the profits from the Russian assets going forward. And this is really important, Guy, because this is a bid for a lot of these countries, which now increasingly, more than ever, face political challenges with their sort of possible support of Ukraine going forward, to say nothing of the U.S. election, where Donald Trump has sort of been a wild card for what the support would look like for Ukraine. This is the move in order to get that financial footing for the Ukrainian defense to become solid for the years to come, really.
Ollie, you talk about the November elections in the United States. Let's factor that into our thinking. How quickly will this money be available? When does it come? Does it come pre-November or after November?
Well, Guy, this is another detail that we're chasing, and I think that the difficulty is that they want to come out with this very strong political message to say, we agree to get this done by year end, and really what they would like to do is really to get it out and get it to Ukraine before the year end. Remember, the election is, of course, in November, but the inauguration is not till January. So I think from the Biden administration's perspective, as long as they can get that deal, figure out all those little nitty-gritty details, and then get those payments flowing, by the end of this year, which is the goal from what we understand, that will be sort of safe, so-called, from any sort of sabotage.
Ollie, is this money going to be used for buying weapons? Is this going to be money that's used to support the military? Is this money that's going to be used to support the civilian population, reconstruction? Are there any limits or criteria that are being applied to the money that is going to be given to Ukraine?
Yeah, guys, so we understand that this money is going to be used for military purposes, but also for reconstruction. But you're right to point this out as a major question, particularly within the EU, right, Guy? There have been member states of the EU with their other various funding programs that have been very reticent to sign up to anything that would go, say, towards lethal aid to Ukraine, right? There's been some objections, not the least of which from Hungary, which has really thrown a lot of spanner in the works. So we don't have all of the details yet, but what we do understand from the architects of this is what they would like to see it go to is that military spend and also that reconstruction.
Ollie Crook joining us at the G7, from the G7 in Bari, Italy. Thank you very much indeed. As we continue to get more details on this story that we've just broken here at Bloomberg, we will bring them to you as the rest of this program and the morning progresses. Let's talk about what else is going to happen this morning. Over the coming few hours, I think kind of circa 11 o'clock, the opposition leader, Keir Starmer, is going to release his party, the Labour Party's election manifesto. He's talking about the fact that wealth creation is going to be at the heart of this manifesto, at the heart of his campaign. Now, of course, at the moment, he has a, let's call it circa 20-point lead over the Conservatives, and it looks like his party is on track to reassume power. It's the first time they will reassume power in 14 years. The general election, of course, is next month. Both Keir Starmer and Rishi Sunak took part in a Sky News event last night. They battled for the upper hand when it came to taxation and, of course, inflation.
It's a very forward-looking manifesto, but there's nothing in our manifesto that requires us to raise tax.
Swerve the top 5% of earners there.
Nothing requires us to raise tax. And I tell you, I do want to. You'll challenge me, and I want to deal with this. I want to do things differently. I want to grow our economy. I accept that previous Labour leaders have sort of pulled the tax lever every single time and driven up spending. I want to grow our economy. The manifesto tomorrow will be a manifesto, a plan for wealth creation.
Promises 1 and 2, halving inflation, growing the economy. You've done that.
Well, the most important priority was the first one, because when I got this job, inflation was at 11%. And I think everyone knows the last few years have been difficult, the impact that was having on all your bills. Every week, you were seeing the impact in your shop, and that's why my priority was to bring down inflation, so to ease that burden. And it wasn't a given, and it was 11%. Now it's back to normal.
Rishi Sunak, Keir Starmer, talking last night with Beth Rigby at the Sky events. Let's kind of pick up and kind of digest a little bit what we got there and what we didn't get, crucially, because we're waiting the Labour Party manifesto a little bit later on. John Stepek, Bloomberg's John Stepek, standing next to me now. John, we've learnt a lot about kind of where taxes aren't going up. I'm kind of still looking for clarity on where they are going up.
Yes, I think I'm not sure you're going to get clarity, to be honest, Guy. Yeah, because I think that one of the things that it seems quite clear from the way that Labour's talking that they would prefer to focus on the idea that the money can largely come from growth that they are going to kind of generate for the economy in some way. Because I think that there's far too much, there's a sense that they don't want to kind of scare the horses. And all of the things that they might raise that they haven't already ruled out all have the potential to kind of frighten people off. So people have kind of talked about the council tax revaluation, for example. Now, council tax for non-UK viewers is kind of Britain's property tax basically. And it hasn't actually changed since 1991, or at least the basis. So all our house prices, it's based on house prices in 1991. Obviously, since 1991, the makeup of house prices across the country has changed a lot. So house prices in London have kind of skyrocketed relative to the north of England, for example. So if you were to revalue council tax, you could raise a lot more money. But obviously, you create a lot of winners and losers within that. And it's a very complicated thing to do. And voters are really touchy about anything that, you know, touches on their houses, even though a lot of voters would probably pay less council tax, you know, the less wealthy you are. The other things are like dividend tax and capital gains tax, so they haven't ruled out anything about that. But again, if you're wanting to be seen as a part, you know, Labour obviously has this kind of hang-up about being seen as not being hostile to business. Because the traditional views of the parties, Tories are pro-business, Labour are kind of anti-wealth. And the risk there is if they spell out any plans they might have to do with CGT more generally.
How capital gains?
Yeah.
How would that undermine this kind of relationship that has been, let's call it, getting better between business and Labour? If you raise CGT tax, capital gains tax, how big an impact could that have?
Well, I think the problem is you're kind of saying to people with wealth, and you're saying to entrepreneurs that you are a target. We've already got the 20% VAT on private schools, which, whether you agree with it or not, is an ideological thing rather than a revenue-raising measure, because it basically raises peanuts. And so you already have this, I guess, sort of like slight anti-rich aspect about them. And obviously, the last leader was Jeremy Corbyn, who was very explicitly anti-wealth. And so I think that, especially when you get Rachel Reeves putting across her Bank of England image, and a very kind of sensible, pro-growth, we're not going to do anything to kind of, scare anyone away, then I don't think that they will want to be terribly explicit about what they might do with, for want of a better word, wealth taxes. I mean, it's also worth remembering that capital gains tax has become a lot less generous, even under the Tories. The allowances have been cut. We no longer have indexation. So capital gains tax is very much a tax on inflation rather than on, genuine real asset growth.
So if you were to raise it, maybe indexation comes back, would be maybe something.
That would be nice.
Yeah, would be nice. Hold that thought. We might come back to it a little bit later. John's going to come back a little bit later. We'll carry on the conversation. I want to talk a little bit about kind of what is happening with the foreign policy story out of the UK right now. What would change in UK foreign policy, both kind of globally and particularly in relation to what is happening with the UK's relations with the EU? Bronwyn Maddox, Director and Chief Executive of Chatham House, joins us now. Bronwyn, great to speak with you. Let's talk about foreign policy. Let's talk about how that could evolve. Do you get a sense that UK foreign policy would materially change in any shape or form were we to see a change of government at this stage?
It's one of the areas where there's least difference between the parties, at least on paper. The biggest difference is probably over Rwanda and immigration policy, where the Conservatives are saying they're pushing ahead with this, and Labour said it will get rid of the Rwanda flights and the possibility of them on its first day. Then you have a difference of tone over Europe, and the question is how significant this might be. It certainly is a difference of tone that, say, those potential conservative voters that lean towards reform and are very much against Brexit might find very disconcerting. And Labour wants to get really as close to Europe as Europe will let it without conceding freedom of movement and so on. Is a good question, which is really up to Europe, of how much wiggle room there is there. But we can expect a change of tone. I'm not sure that much in practice. And then you have really great areas of similarity of trying to deal with China in a way that allows us to protect ourselves, but also trade with them and so on. Ukraine, they're in the same position, though Labour has never been terribly comfortable with the idea of long wars. That said, many defence secretaries, good ones, have been Labour. So big areas of similarity and a few differences.
What do you think defence spending would look like? Do you think we'd see significant differences there? As you say, like in the past, we have seen defence secretaries under Labour being some of the biggest proponents of a growing and a more effective military. What do you make of Labour's plans on defence, and how different do you think the military could look after a few years of a Labour government?
Again, on paper, there's very little difference, particularly now that Keir Starmer has said that he would uphold the Trident nuclear deterrent and indeed, put more money into repairing, refurbishing it and so on. I think, again, it's a question of tone and how Labour, if it gets in, responds to events. And the big event hanging out there, obviously, is Ukraine. What happens there? Because for all that the parties have been battling over percentage points of GDP, and both now committed to 2.5%, which Chatham House think it actually probably needs to be a bit higher to do what they say. The question is, what are you spending it on? And what it needs to be spent on is actually repair of armaments and munitions and missiles and so on, providing more of those to Britain and to Ukraine. So I think we'd have to see in response to events, but if Ukraine is going to continue to have really a very, very tough time, there is going to be pressure on Britain to spend more there. And if a US president gets in who does not or cannot through Congress get support, then again, pressure on Britain.
Bronwyn, let's talk a little bit about what's happening with and you referenced this earlier, with the EU. You say that the Labour Party would like to get closer, but it really is up to the EU to decide kind of how that is going to work. Given the consequential nature of the relationship the UK is going to have with the EU going forward, why is this such a small part of this election debate? Why are all the major parties so terrified, it seems, of talking about how the relationship could get closer in a different form, but a more workable relationship? Even the Liberal Democrats kind of buried it at the back end of their manifesto, their Orange Manifesto. Why is this something that the parties don't want to talk about, given the consequential nature of that relationship?
You're absolutely right. It is Britain's closest and largest trading partner. The reason is that the two main parties do not want to say the word Brexit. They don't want to frighten off voters who are very much for Brexit by suggesting that it might in any way be compromised or even reconsidered. And Labour has said it really doesn't want to go there. It also, I think, in Labour's case, doesn't want to promise things that it can't deliver, because the European Union it might well much prefer to deal with Labour and be much smilier in dealing with a party that has not been associated in the same way with Brexit. But on the other hand, for the EU, it is really sacrosanct that if you're going to enjoy the benefits of the single market, you have to accept things like freedom of movement of people and various other points. And that is for Labour somewhere that it just can't go. So we're really onto smaller things about students, about in the jargon, phytosanitary agreements, about food products crossing borders without as much paperwork. But it's very hard to make a big inroad into that relationship without doing something like joining the customs union, which would mean scrapping the trade relationships that Britain has already begun to write for itself, and so on. So there's not an awful lot of wiggle room there, I think.
Yeah, very effective, some of those customs relationships that we've been dealing with so far and signing up to. I just wonder whether the maths might ultimately speak through on that front. Bronwyn Maddox, Director and Chief Executive of Chatham House, thank you very much indeed. The other area that we haven't talked about yet, of course, is what is happening in the housing market. Housing affordability, a major issue in next month's election. We're going to speak exclusively next to the CEO of property data company Zoopla. That conversation is next. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Talk about another major issue with the UK election, housing affordability, what's happening with the rental market, how do you get onto the property ladder, all key issues. The Conservatives, of course, plan to abolish stamp duty for first-time home purchases, that number up to £425,000. Labour promising to build more homes and give mortgage guarantees to first-time buyers. What does this all mean? Let's find out. Let's get back to the Founders Forum. Tom McKenzie is standing by with a great guest to talk to about this. Tom.
Guy, thank you very much indeed. Yes, joined by the CEO of Houseful, is the parent company of Zoopla, so the CEO of that company as well, Charlie Bryant. Charlie, thanks for joining us. Guy was just outlining some of the proposals from the Labour Party and the current Conservative government around housing and how to fix UK housing. Let's start, there's a few things here. Let's start with the Help to Buy proposition from the current government. They want to put that in place, a new and improved, is the way they've described it, Help to Buy. So essentially they give a 20% loan to first-time buyers. That means the deposit can be as little as 5%. How helpful or not is a policy like that? Does it just reward developers? Does it just push up prices? Or does it meaningfully impact the housing market to the positive? I think it does help more people get onto the housing ladder. And, you know, we've had Help to Buy in previous iterations. And what we saw there is it actually helped a lot of younger people in particular to get onto the housing ladder. But it was very pro the house builders in the sense that at that point in time, it was only available on new build housing. So really propped up the house building sector. You know, I think what we want to see now is something that helps both resale and new build properties and is sustainable for the long term in helping more people get onto the housing ladder and get out of what is a really, really competitive rental market right now. Would a scrapping of stamp duty for first-time buyers be part of that mix for you? I think it can certainly help. The reality is the average home in the UK costs $300,000. So actually there are a large number of homes already that fall outside the stamp duty net. But if that was, as has been tabled, raised to $400,000 plus, clearly that would bring a lot of homes outside of the stamp duty net. But the reality is the vast majority of stamp duty today is raised from the smallest proportion of home sales, right at the top end of the home price bands. And mortgage guarantees is a proposal. Labour will be coming out with their manifesto later today. We expect to see something in terms of mortgage guarantees. Is that something you'd welcome? I think it helps the banks get greater certainty about higher LTV lending. Undoubtedly, the biggest issue with mortgages for first-time buyers right now is just the absolute size of deposit that's needed. So if there is, again, a sustainable and workable structure that isn't just pushing a problem down the road, that helps more people buy a home with a smaller deposit, undoubtedly that helps, and we see it in a number of places on the continent. It's worked pretty well. What is the health of the UK housing market right now? It's been more resilient than many had predicted in an environment of rates of north of 5%, 5.25%. What is the current feel? You've got a finger on the pulse of this housing market. I think that's right. So, you know, if we look at it, the number of homes for sale right now is 20% above where it was last year. Estate agents, on average, have 31 properties for sale at the moment, which is the highest number for 8 years. But the good news is a lot of those people who are selling their homes are also looking to buy homes. So you're beginning to get that momentum back into the housing market. Do we need a rate cut? Listen, a rate cut is always helpful, obviously, because it brings the cost of home ownership down. I think the most important thing for the health of the housing market, though, is predictability. If people are unsure whether rates are going to go up or down, what they tend to do is they tend to sit on their hands a little bit and say, OK, I'll play out and see what happens before making a move. In terms of house building, governments, and not just this government, previous governments have missed the targets. They're now selling, current government, 1.6 million homes over 5 years. Labour, 1.5 million. What is standing in the way of more house building? We sit here in the Cotswolds, the bucolic Cotswolds. Do we need to be concreting over these green fields to build new houses? Hopefully not, because they are genuinely beautiful out there. But listen, it's a combination of things. I mean, I would say over the last few years, there have been a bunch of hopefully
non-long-term extraneous impacts on the house building sector. So there's obviously been, post-pandemic immediately, the lack of availability of building materials. Then there's been the price inflation in building materials. That for a long period of time, there was a real issue with what had historically been a big reliance on migrant labor for building sites. So, you know, those I would say will have been more...
But does planning need to be reformed? Do you buy these targets, are they achievable?
As you say, no one's achieved the targets before. We've generally built less than 200,000 homes in the UK for a fairly long period of time. The current targets imply something nearer 300,000 homes per annum. So planning is certainly going to play a part of that. But it's inevitably hugely controversial, as you say, particularly in the bucolic Cotswolds.
What's happening with the rental market? You've seen rental prices come off a little bit, but you've talked to me about your concern about the rental market.
Yes, the reality is the rental market has not changed in terms of the overall level of private rental supply in 10 plus years. It's still about 5.4 million homes, yet people have been living longer. First-time buyers are getting older. You know, you used to buy a home in your 20s, it's now in your late 30s on average. And net migration outstrips the number of homes being built. So yes, more and more people are turning to the rental market. The reality is, whilst rental supply is up about 18% versus where it was last year, the reality is there are 15 people chasing every home for rent, as opposed to 6 people chasing every home for rent pre the pandemic. And in a supply-demand market like that, inevitably that pushed rental prices up dramatically.
And you see rental prices staying elevated for the medium to long term?
Listen, the rate of growth has come down. You know, a year ago it was 13%, now it's about 6.7%. You've seen rental falls in some areas, but that's driven by affordability rather than supply and demand. They just got to a level where they'd outstripped wage growth by so much that people just couldn't afford to pay more rent.
Okay, 15 to 1. It's still a statistic, isn't it, that really raises the eyebrows. Charlie Bryant, thank you very much indeed. CEO of Houseful, parent company of Zoopla, CEO of that company as well. Guy, back to you.
Great conversation, Tom. Really useful, just in terms of the challenges and the fact that we just haven't delivered on the targets of house building consistently year after year after year. Is that about to change? You can understand why people are skeptical. The CEO of Zoopla there on his views surrounding that. I want to take you back to Italy. I just want to remind you that this event is happening. The G7 is taking place right now. You are currently seeing arrivals of the leadership in Bari. That looks like Charles Michel joining. My eyesight may deceive me, but I will get a close-up right now. It is. There you go. Meeting Giorgia Meloni, the Italian Prime Minister. So we're watching arrivals at this event that is taking place in Italy. We have been obviously tracking developments. It looks like we have seen an agreement between the G7 leadership on exactly how frozen Russian assets will ultimately be used to help and support the Ukrainian war efforts and also the reconstruction effort that is taking place. We'll continue to watch what is happening there. In terms of the markets, let me just kind of give you a sense of what is going on right now. We are watching equity markets stabilizing, obviously a big gap higher as a result of the CPI print we saw yesterday, a little fade after we saw the Fed dot plots being revealed. This morning it looks like the S&P is going to open up circa 0.2%. That's what the fair value calculation is currently pointing to right now on my Bloomberg terminal. So it looks like we're going to see a bit of stabilization maybe later on today. We've still got PPI to come out. We've still got a number of other data claims to watch out for as the session develops. The pulse is up next. No, the brief is up next. This is Bloomberg.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago because Treasury bills are 5%. So I would say, you know, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, a million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Good morning from our global headquarters in New York. I'm Danny Berger. Manish Kranny is on assignment this morning. Welcome to Bloomberg Brief. Let's set your agenda. It is another record. Stocks break 5,400 for the first time as Wall Street bets on at least 2 Fed cuts this year. The G7 kicks off in Italy. Terms are agreed to provide $50 billion of fresh aid to Ukraine. And Elon Musk says that his $56 billion pay package will get the green light ahead of today's Tesla AGM. Well, welcome to the show this morning. It is the hangover from the CPI Fed party. It is another record in stocks. This time it's helped not just by a cooler CPI, but tech. Broadcom up some 14.25% this morning after strong earnings, thanks to their AI demand. As for 10-year yields, little change this morning. Some of the euphoria, the giddiness we had in this bond market yesterday after CPI was curbed by a sober Fed. Nonetheless, we did end the day about 8 basis points lower. 4.31% is where you stand on your U.S. 10-year yield. Perhaps the asset with the biggest turnaround yesterday in reaction to a more sober Fed was the dollar. Dollar ended the day lower today, slight strength, euro down. Barely down, unchanged this morning. 108 is where you stand on your euro dollar. Now, that Fed's latest dot plot, it did little to squash Wall Street's confidence in penciling in 2 rate cuts for this year. Perhaps the Fed is just a lagging indicator. Inflation data showed a second straight month of cooling. Here's what former Fed Vice Chair Richard Clarida had to say.
In some ways, the Fed got trumped yesterday by the data. The CPI numbers were very Fed-friendly. Even though you could argue the Fed on net was hawkish, it was on net a dovish day in markets given the CPI report. They are in data-dependent mode. I know it sounds trite, but I think they need to see a lot more good inflation data to have the confidence to cut.
There's a wide belief out there that perhaps the market is more right than the Fed's dots, that, again,
they're just lagged behind. Here's what Peter Scheer of Academy writes, that we learned more from the CPI than the Fed, perhaps. The dots pushed one rate cut from this year into next year, largely expected, especially since the dots didn't have today's CPI print, or yesterday rather. Joining us now is Katrina Dudley, Senior Investment Strategist at Franklin Templeton. This seems to be the refrain. Andrew Hollenhurst from Citi also said this, that look, they just didn't incorporate the CPI into their dots. I don't understand this. Why not?
I think the one thing we've got to remember about the Fed is that they have been so clear. Isn't that great that we've got a Fed that's saying we're waiting for the data and we need to have sustainable prints of lower CPI towards that 2% target, so sustainability. And the one thing that we think that the market really doesn't appreciate is there's something happening in November. It's the US election, and we're one of many countries that are going to the polls this year. But for the US, the Fed really doesn't want to be seen to interfere in that election result. So that also is going to impact some of the timing. So you may have one of those rate cuts kind of be pushed into next year.
So wait, do you think that affected some of what we heard, what was interpreted as hawkish? It was actually just Powell and team playing a little bit of a waiting game until the election.
I think that's exactly right. And don't forget, the beginning of the year in terms of, the calendar is just an arbitrary date. And so, if it moves a month out, does it really change the fact that, Wall Street's expecting 2 cuts? I think, the Fed's guiding to 1 this year, maybe 1 early next year.
So do you think that if they had the CPI in hand, actually it wouldn't have really changed the dots?
I really don't think it would, because the CPI is kind of gradually doing, and if you look at some of the comments, you look at what's happening in the Euro region, they keep telling us that this last mile is that hardest mile. If you're running a marathon or you're in a race, you kind of get the first miles in and it's easy and you're running along, but when you have that last one, yes, you can see the end in sight, but it's a tough race.
Well, Powell was asked, why not just do an ECB, if you will? Why not just cut once in the summer, wait and see how things go? He said that there are risks for both waiting longer and moving too quickly, that both of them have risk. What do you think is the bigger risk?
I think that the bigger risk is going too early. I think that the economy, the data that we're seeing out of the economy is really positive. You look at the jobs number, you look at the earnings number, and it's a positive, positive momentum, particularly here in the United States. A lot of people are focused on the Magnificent Seven. They're also focused on the technology, and that's been a big driver of the earnings number. But there are other parts of the economy that are doing well. The industrial sector is continuing to print good numbers. Our old-fashioned utility sector is actually also printing good numbers. They're another AI beneficiary as well.
Yeah, I mean, it's kind of turned into a mad world when, like, your safety stock is all of a sudden an AI stock as well, but that's what we're living in.
Yeah.
I mean, I can't help but wonder, okay, so the inflation number looks much more benign. It's looking much better, and this was discussed a lot in the Powell presser, too, that you still have the oddity of owner's equivalent rent. You still have a housing inflation that's lagged, that's still higher than presumably it actually is here today in reality. So doesn't that mean that inflation actually is pretty much at target, and you could almost celebrate job well done once you take away some of the housing oddities?
Some of the housing oddities are just a slight delay effect. So, for example, if you rent, most people enter into a contract, there's a 1-year delay, in terms of repricing that because of just that natural cadence. And I think that that's the first indicator, and that data has always been on about a 6-month delay anyhow, so you're 6 months plus another year. I think we're seeing that. But have a look at some of the other underlying components where we're seeing some kind of interesting movements. Auto insurance, for example, insurance rates, and if you've tried to get car insurance, I know most people in New York probably don't, but most of America drives a car, and they're seeing rate increases of 20+%. All of my friends who moved to Florida are seeing huge increases in their insurance as a result of, flood risk and all of these other things. So, there are still pockets of inflation, and some of those pockets are actually driving significant moves in the CPI. As we look, however, at the Fed, what we want to see is kind of just guidance, and what you're seeing from the Fed narrative is that we're continuing to watch and we will continue to monitor. And as soon as it's justified, we can drop rates by 25 basis points, but we need to see real progress over a number of months.
Right. By the way, I love that you say all of my friends who've moved to Florida, because we all have all of those friends who have moved to Florida. They've all done it post-COVID. Look, there's this argument, Omar Sharif basically makes it, that if you look, for example, at their long-term projections, something like 2.6%, they're still elevated, which gives this idea that not only is the Fed not super confident that inflation is all the way reined in, but for the long term, they're not as confident. He calls it inflation PTSD, basically from the first rough quarter. Do you think there's some element of that that's hesitancy to say our long-term rates, we can get them back to where we want them to be?
I think in terms of that 2.6 number, I actually think that, you know, when we're looking at close to 2, we've been debating what close to 2 means. Does it mean between 2 and 2.5, and then 2.6 there is not that different from getting under the 2.5? And I think that's where that guidance number is. 2 is a comfortable number for an inflation number. It's kind of that Goldilocks scenario, not too hot, not too cold, and I think that that's what the market is pricing in. What we're looking at is, you know, the ability of companies and the ability of the economy to adjust to, you know, higher interest rates, the ability of the companies to be able to adjust to higher inflation. And don't forget, they're actually, you know, the second derivative is really that important number, and they're starting to see that kind of come down. And so you've got a lot of good things. We have the AI trend. So we're actually, I'm optimistic. I think that, you know, a lot of people are very critical about our ability to soft land this economy. I've seen things that said soft landing now is the bull case, but I actually think that's still exactly where we're going to end up.
On the AI trend, there's been much debate over whether or not it actually leads to this productivity boom akin to what we saw in the age of the internet. Torsten Slok was on this program not too long ago and basically said it's not going to be the same. It's not like the internet where everyone can just wholesale adopt it. AI is different. Do you think we're going to see an internet-style productivity boom from AI?
So I use AI. I mean, and
how,
here I am.
Katrina, this is what I want to know.
Exactly. So I use it to make my time more productive. So if I'm looking at meeting with someone, I can use AI to help me generate an agenda. If I'm writing something, I can put it into AI and I can help it make me a little bit more productive. So if I look at the use for me, it's kind of taking my existing job and making me more productive.
Does this mean you're buying the new iPhone, the new AI-enabled iPhone, Katrina?
I am waiting at the moment. I have kind of a slightly older version, but
there you go.
It's an example of someone, you know, of my generation basically saying AI can make me more efficient. At the moment, it is making me more efficient in my existing processes, but I look at what we're doing as a company and I look at some of the use cases we're investigating for AI within our research process, and some of those use cases are really innovative, and I think that that's the next, you know, bolus of productivity to come. So it's kind of, it's still in development, it's still early days, but you have the people like me automating existing processes and these new processes to come. So I'm actually a lot more optimistic.
You're going to have to give me a lesson on how you do these things. That sounds excellent.
Oh, it
sounds like it's going to take my job, though, so I'm a little bit concerned about that.
It actually won't.
Oh,
that's the interesting thing, because when you look at it, you know, you write the content, it just elevates it. It makes what is good kind of better. And I think that that's the thing that people don't understand. The other element is AI is great, but it doesn't, you know, it just can't replace the fact that we have the ability to make connections that other people can't. We have the ability for innovative thinking. I think that the human will not be replaced. But, you know, we've heard this argument before when we automated farming, and look where we are today.
True. Well, Katrina, you're helping me sleep a little bit better at night, so I appreciate that. Katrina, thanks for your time this morning. Katrina Dudley of Franklin Templeton. Okay, let's get you some of the other top stories that are trending on the terminal this morning. Speaking of AI and Apple says that it is not paying OpenAI to use its chatbot. Instead, Apple believes that promoting ChatGPT to its users is of equal or greater value than monetary payments. That according to people familiar. Separately, Sam Altman told staff that OpenAI is on pace for $3.4 billion of annual revenue. Elon Musk says 2 shareholder votes are passing by a wide margin, his pay package and moving Tesla's headquarters to Texas. Both Musk and Tesla have been rallying support for both measures in recent weeks. The shareholder meeting does take place later today. Jim Chano sees plenty of opportunities for short sellers as the relentless bull market leads to bloated valuations. Chano spoke yesterday on Bloomberg The Close.
I've called this the golden age of fraud. So there's just so many companies, so many companies now that are playing games that are to try and take advantage of investors. So we need short sellers more than ever.
Coming up, we're going to bring you our exclusive interview with OMV CEO Alfred Stern as the oil and gas giant grapples with court cases that may jeopardize fuel flows. That's to come on Bloomberg Brief.
world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's your Bloomberg Brief. I'm Danny Berger in New York. So European gas is extending gains for its fourth day. It's trading at about the highest in 6 months. This as Germany's Uniper has been awarded 13 billion euros in damage after Gazprom cut off their supply of Russian gas back in 2022. Austrian energy company OMV warned last month that these type of court cases may disrupt overall fuel flows, given that more than 80% of Austrian imports over the last 7 months have come from Gazprom. Joining us now for an exclusive interview is OMV CEO Alfred Stern. Alfred, good morning to you. Thank you so much for joining. So the concern here, essentially, Uniper gets $13 billion in damages. That if Gazprom isn't paying this, then you'll have to redirect the money you're paying in your contract to Gazprom to Uniper. So we've gotten this court decision, 13 billion euros. What now, Alfred?
Yeah, good morning, Danny. Great to speak to you. Indeed, this is apparently what one could see in the press about Uniper. And I can confirm to you that OMV has released an urgent market message a few weeks ago that was highlighting such a risk, because what could happen is that the payments of anybody to Gazprom in Europe could be seized and relieve then the party of its debt to Gazprom. So that is a potential risk. We have been preparing for such events for the last 2 years. We have diversified our supply sources. We have booked pipeline capacity so that at any time we can ensure that we can deliver all our customers also with non-Russian gas in case such a interruption should happen.
Okay, so Alfred, just to be clear, because I think, there is some concern of the scale of interruption of flows. So if this happens, you can't pay Gazprom, the contract isn't existing in its current form. Just what does that look like? Is there any level of disruption or flows? Are you prepared at 100% to continue to deliver the fuel that is needed in Austria?
Yeah, we are prepared 100% for all the customers that have contracts with OMV to replace that with non-Russian gas. We have spent a lot of time and actually worked hard to make sure we have access to our own equity production in, for example, Norway. But we have also made third-party contracts in Norway, in Italy. We have made long-term LNG contracts and can use our capacities at the Gate terminal in Rotterdam. And then we made all the pipeline bookings to get us to the markets where our customers are active so that we can supply at any time the customers with gas, with non-Russian, in case the supply from Gazprom stops.
I mean, there's other threats from the flow of Russian gas. One is that Ukraine is unlikely, and has said so, that they're not going to extend their contract to have Russian gas flow through Ukraine. You say that you're ready, you're prepared for alternate routes. But Alfred, what sort of market reaction do you expect? It's been a volatile market. If these types of flows cease to exist at the end of the year, what happens?
Yeah, so in Europe, the supplies from Gazprom have reduced, the pipeline supplies have reduced significantly. There are still LNG supplies from Russian gas coming to various countries in Europe, but the pipeline supplies have reduced significantly. But there is a few countries, and mainly the pipeline through the Ukraine, where still Gazprom gas comes to Europe. That is lesser than it used to be, and with this one should expect a smaller market effect. We at OMV, our Gazprom contract is such that the supply location is the Slovakian-Austrian border, and we expect the deliveries to happen there. If they don't, we are prepared at any time to supply also non-Russian gas.
The irony is, you say that there won't be too big of a disruption to markets. You see it a little bit because Europe, as you say, you have alternate routes. It is awash in natural gas supply, but we continue to see these little areas of disruption. For example, there have been outages. There's warm weather in Egypt. There's warm weather in Asia, making concerns about competition for the flows. There was a disruption to Libyan gas supply. All of these have had some impacts on prices, but not huge. Alfred, at what point do we actually need to start worrying about the continued disruptions?
So I think the supply demand picture in Europe, but globally in particular with gas, is volatile. I would agree with you. There's always two components. The price is driven by supply and demand, but then there's, of course, also a psychological aspect to the pricing at the hubs and the marketplaces. And what we have seen over the last 2 years is that every little disruption, if there's a issue anywhere in this world, that we see that very often this has very quick impact on some price changes. However, what we have not seen is the huge increases that we saw during 2022 and 2023, because a lot of rebalancing has happened. New LNG terminals have come on stream. People made new contracts like OMV have, like I just described before. But it will continue to be an issue. That's why, for example, we at OMV developed the EU's biggest gas project in the Black Sea in Romania with Neptune Deep, because we believe that supply production in Europe is one of the best security of supply measures that we can make.
Right, so there are scars of the crisis, but you've rerouted, you've readjusted. Alfred, you've also been having discussions with ADNOC to merge your chemical units, discussions which have stalled. What are the issues still holding back the merger?
So we continue to have ongoing discussions on a potential combination of Borouge and Borealis with an open-ended outcome. The industrial logic for such a deal is quite clear, I think, to bring together two leading companies, Borouge and Borealis, to make a bigger company there. I think we can all see that industrial logic, but of course, it's a high-stakes deal for both OMV and for ADNOC. It's also a complicated deal, and that does require in-depth discussions. We have more than 30 years of business relationship with Abu Dhabi. We are experienced in this, and we have made good experience to ensure that we are properly discussing the things before moving forward. So it's a complicated deal, open-ended, ongoing discussions, and we at OMV are focused to ensure that this is also value-creating, that the interests of all of our shareholders are maintained.
All right, Alfred, we're going to have to leave it there. Thanks for joining us this morning, the OMV CEO, Alfred Stern. Coming up on the show, a look at what else is making headlines around the world. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Your Bloomberg Brief on this Thursday morning. I'm Danny Berger in New York. Let's get you some of your front page news. A look at what's making headlines around the world. First up on the AP, the G7 summit is opening. They've agreed to a deal for $50 billion in aid to Ukraine. Part of that is using frozen Russian assets to help the overall package. Separately, President Biden and Zelensky plan on signing a security deal. We are live, and we're going to have a live report for you from the G7 summit in Puglia, Italy, coming up as the world leaders meet there for the family photo. Next up on the Washington Post, former President Donald Trump will meet with Republican lawmakers on Capitol Hill today. His goal is to unify the GOP behind his agenda. It's going to be Trump's first public visit to the Capitol Hill since the January 6th attack. And how about this one on Bloomberg? Manhattan rents dropped in May. It's odd. It's usually a time in a season where rents are picking up in the demand of the spring. However, they are now at a median $4,250. That is a 3.3% decline. That's according to appraiser Miller Samuel. That is because there was more supply along with demand. Okay, coming up, we head to the world of private credit, a conversation with Anthony Fobel.
October of 2019, you surprised the business world by stepping down as the CEO of SAP, a very, very large company whose value had more than doubled during your co-CEO position and CEO position. And you took a position with a much smaller, less known company, ServiceNow. Usually people, when they leave a job, they go to a bigger company. Why did you go to a smaller company?
Well, I saw the future and where it was going. First of all, I want to say I had a great run at SAP, and it was a pleasure taking them from 39 billion to 163 and really inspiring lots of people and customers, and it was a wonderful experience. But after 17 years, nearly 10 as CEO, I was ready to do something different. And when I saw ServiceNow in the marketplace, I knew what it was, and I knew what it could do. And I knew with my background, I was a pretty good cultural fit for what ServiceNow needed to scale it.
So let me ask you, what does ServiceNow really do? Tell me in simple English language that everybody can understand. What do they actually do?
40% of the CEOs say today, if I don't digitize my operations, my company will no longer be viable in less than a decade. So we were the IT backbone for companies all over the world. How do they manage their assets, run their operations, secure their operations, all things digital having to do with IT.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Good morning from a beautiful sunrise over Central Park here in the New York headquarters of Bloomberg. I'm Danny Berger. Manish Cranny is missing this gorgeous picture. He is out on assignment. Let's set your agenda. Fresh record highs. Stocks break above 5,400 for the first time as Wall Street bets on at least 2 Fed cuts this year. Elon Musk says his $56 billion pay package will get the green light ahead of Tesla's AGM today. And G7 kicks off. Terms are agreed to provide $50 billion of fresh aid to Ukraine. The leaders meeting in G7. In the meantime, it is an equity market that is trading at all-time highs. Futures higher yet again, up 0.1%. It was a giddiness we felt after CPI. Okay, it was curbed by Powell and co, who had dots at just 1 cut this year. Even so, we are continuing to gain on both stocks thanks to Broadcom, a big tech earnings, a big Broadcom gaining some 14% in the morning's trade. 10-year yields, those are down by about a basis point. 4.3% is where they trade after a drop of 8 basis points yesterday. Finally, your euro dollar slightly weaker. The dollar did decline after we heard from Powell, a more hawkish Powell than perhaps we expected. So what does higher for longer mean for the world of private capital? We are seeing private equity deals picking back up. It's, of course, great news for direct lenders who often finance those deals. But again, it is a world of higher for longer. Joining us now to discuss all this and more, it is Anthony Fobel, CEO and founder of Arkmont Asset Management, which has 29 billion euros under management. Anthony, it is so great to see you. Thank you so much for joining this morning. So here we are, 24 hours out of a Fed, less than 24 hours out of a Fed who essentially did nothing and signaled they're just going to cut once. That after an ECB, which did indeed cut, divergences in with a stronger U.S. What difference does it make to you and your global allocation?
Well, first of all, very good to be with you again. And, you know, we've been in an environment now for a number of years where we have had pretty high interest rates. And for the private debt asset class, that's been a very good thing. One of the great features of this asset class is that our loans are variable rate loans, which does mean that as rates have gone up, really in response to higher inflation, the return for our investors has gone up. So I guess we're going to remain in an environment with elevated rates and I guess elevated returns for our investors.
It's great for your investors, Anthony, if I can jump in, those elevated rates. But there has been this criticism of the world of private debt that companies also have to deal with those elevated rates. And we've been in a world, again, this is the criticism of extend and pretend. Just be lenient to your companies and hope they can get through to maybe when rates are lower or something else changes. So what happens if we don't get that? Is there a maturity wall that all of a sudden looks more steep and more threatening?
Yes, I mean, I certainly think that higher rates has put pressure on a number of businesses. I suppose from Arkmont's perspective and many other players in the private debt industry, we have a slightly skewed portfolio in the sense that we are very much focused on businesses that tend to be less cyclical, but also very cash generative. So if I just look at our own portfolio, for example, we have very few businesses that have seen a lot of pressure on their cash flows as a result of the higher rates. As I said, that's probably not representative of the broader market, but that's certainly the case for us.
Yeah, the broader market has seen weird things, like, for example, Oaktree all of a sudden having to own an Italian football team because they breached the covenant and defaulted. I mean, this is an odd time. It's happened before, but maybe not to the scale, the size of private capital is. Anthony, you say you're prepared. You have these high cash flow companies, but is private capital, is private debt prepared for what's coming its way?
Yeah, but look, I think we have already been tested. You know, we've been living in this high rates environment for quite some time. It's remarkable that our portfolio companies are in many cases paying twice as much interest on their debt as they were probably 3 years ago. So, you know, the companies have accommodated that. I think that was also against the backdrop of a very uncertain economic environment. I think one of the things that has helped businesses is the fact that although they're paying higher rates, certainly in Europe, we've entered into a much better economic environment where companies are seeing growth as well. So I don't want to make light of the issue. I think there are businesses that will come under pressure. But, you know, in our industry, it's a sort of strange thing that, in a sense, us receiving too much interest is almost a high-quality problem, in the sense that there are things we can do about that. What we really care about are situations where we see declining EBITDA, because in those cases, there's very little we can do about it. And I will say, quarter on quarter, we have seen an improvement across our portfolio, generally, including things like interest coverage costs.
Well, Anthony, you've also said that you've seen a significant pickup in M&A activity. Can you just outline what exactly that pickup looks like? How far away are we from something that looks like the boom times of 2021, and what's the quality of that M&A?
So, again, private debt's been somewhat insulated from the decline in M&A volumes because during the last couple of years, you've had a period where effectively the banks haven't been lending and the liquid markets have been closed. So we've benefited from effectively being the only game in town. As you correctly say, Danny, we're now seeing an environment where the liquid markets are starting to open and open with a vengeance, particularly in the US. And so that's removed from private credit a lot of those higher larger deals, which historically would have gone to the liquid markets that private debt was doing. However, the countering factor to that is that we are seeing a quite dramatic pickup in M&A activity. And in many senses, we would be lead indicators. You know, we'll find out about those deals long before the markets do. And just to give you a sense of it, we've had a pretty good year in 2023. Year to date, our deal volumes are up 70% on last year. So we are definitely seeing that significant pickup. And a lot of it is driven by the fact that private equity firms feel that the economic environment is better for investing than it has been historically. But also, frankly, they've been sitting on dry powder for a couple of years and have to do something about it.
Yeah, deals need to get done or else LPs are unhappy. Anthony, there's also been a trend of consolidation, one that Arcmon has taken place in. Nuveen bought you about a year ago. Do you expect that to continue? Is there more consolidation to come in this industry?
Yes, I think it's inevitable. I think as the asset class has matured and essentially grown up, one thing is absolutely clear, that LPs, investors, want players with size and scale, partly because these are complex businesses. You know, if you look at our business, you know, we've got offices across Europe, we've got multiple products, it demands significant infrastructure. So investors are looking for scale players. I think also the larger players have managed to do larger deals, which by and large are safer deals. So that's also reflected in better portfolio performance. And you are seeing really a significant number of consolidation events. And certainly I can say from our perspective, us joining the Nuveen Group alongside our sister company, Churchill, has been hugely beneficial. You know, wherever I travel in the world, the fact that we can now say that Nuveen Private Capital has $74 billion of asset under management and a global presence is really resonating with investors.
Do you think it's healthy for private capital, for private debt to be specific, becoming the land of giants? Is this a good thing for the industry, that perhaps the smaller players can no longer survive?
I don't know if it's a good thing or a bad thing, but it's going to happen. You see, I think one of the problems with private credit and lending generally is there's no real upside in debt. What we need to focus on is getting our interest paid and returning money to our investors. And the thing that's always worried me about smaller businesses, and just to be clear, when we were a smaller business, we did smaller deals, is that they are riskier. And I'm just not sure you are paid for that additional risk you're taking. And so I think it will migrate towards being, I think, an industry for large players. But like every industry, there will always be space for very high-performing niche players with very strong strategies and very good teams.
Okay, Anthony, thank you so much for joining us this morning. We appreciate your time. That is Anthony Phobel of Arcmont Asset Management. Okay, coming up, we're going to bring you a live report from Puglia, Italy, on the shores of the G7 summit. That's to come.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
This is your Bloomberg Brief. I'm Danny Berger in New York, and it is a full agenda down in southern Italy. G7 leaders are meeting. Details of a deal to provide Ukraine with $50 billion of aid using some profits generated by frozen Russian assets. It has been hashed out. Let's get over to Bloomberg's Anne-Marie Hordern, who's there in Italy, keeping track of the latest moves. Anne-Marie, what are the contours of this deal?
Well, this took months in the making, and my reporting, along with Alberto Nardelli and Victoria out of Washington, D.C. this morning, we have learned that a deal has been reached. So approximately $50 billion worth of a loan of cash by the end of the year will flow into Ukraine. What this means is that different countries are going to structure the loan themselves. There's a lot of discussions about the technicality of this. How would they be able to do this? The countries that are going to sign up for this, they will deal with it on their own on how they would like to give this loan to Ukraine. And then they will be repaid back as the interest of this about $300 billion worth of sovereign assets, these central bank assets, mostly held in the European Union. As they accrue interest, that interest then will be paid back to these countries that are front-loading this money to Ukraine. Now, we do know that some of these technical details will be continuously be discussed following the G7. They do want to get the money to Ukraine, though, by the end of the year. And Danny, what is really obvious to me is that the Biden administration, which for months has been trying to do this, as well as some of these other leaders, understand that there are some big elections coming up. Look at Rishi Sunak. Potentially the UK Prime Minister will not be the UK Prime Minister in about 2 weeks' time. Obviously, as well, a cloud hanging over this G7 is that potentially this is the last G7 for President Biden. So this is a way to foolproof future funds to Ukraine, and U.S. administration officials would tell you that that financing is dire need right now.
It is such a good point, and we're seeing just moments ago the pictures of Biden and Meloni greeting Macron there and Trudeau of Canada. It's also France at the same time too, Anne-Marie. You make such a good point. This happening just after the European parliamentary elections. It is a whole host of leaders who are weakened. How does that color any agreement? Is what you're saying, Anne-Marie, that this potentially doesn't stick because we don't know who will be at the next G7 summit?
Well, the $50 billion, if they're able to get it there by the end of the year, that Ukraine will have that cash and they can start financing, and this would go to restructuring of their infrastructure that's in critical need. And this was a key goal for the Ukrainians. Dmytro Kuleba sat down when John and Lisa and myself at Davos, and he said, this is the goal for 2024. And now we see the political will, and now we do see a plan that is going to be implemented following the G7. So that is why there was such a push to get this done. This G7 really felt like the final moment they can get this done. But for some of the other agreements potentially we could see on the sidelines here, potentially they will not be election-proof. The President Biden will be sitting down Volodymyr Zelensky today, and they're going to be giving a joint press conference. And Zelensky came out and said that it's unprecedented, this bilateral security agreement that the United States and Ukraine are going to be signing on today. Potentially, this is another provision that the U.S. wants to election-proof. But the issue is this is not a treaty. It's not going through Congress. A future president could take the U.S. out of it. So that is why there is this cloud of uncertainty, and it's parochial almost, because these countries are dealing with immense amount of pressure at home that they come here without the mandate, really, of their electorate, given what we've seen with the parliamentary elections across Europe, except for Giorgia Meloni. She is the standout, and I will say, Danny, that this almost feels like a coronation of a new European leader at this G7.
Fascinating. Anne-Marie, thank you so much. Bloomberg's Anne-Marie Horton, who will be back with her surveillance team in just a short little bit of time. Surveillance starts in about 15 minutes. Okay, let's bring things back to here in the U.S. It's Tesla's annual meeting this afternoon. And it really means one thing. Shareholders, they have voted on Elon Musk's pay package, and we will find out the results of that $56 million price tag. Musk himself took to X to post that both the resolution to ratify his pay package and their move to relocate Tesla from Texas to Texas from Delaware are currently passing by wide margins. Let's bring in Bloomberg's Craig Trudell on this. So, Craig, is it happening? Is Musk finally getting his pay package of $56 billion?
Yes, it takes some of the drama out of the day, although it's very Muskian for him to sort of front run his own annual meeting. I also, just think it does, potentially reinforce some of the very concerns that Delaware raised about how this pay package came together and the extent to which the board is really governing their CEO, and that it's quite unusual for an executive to, ahead of an annual meeting, put something on social media about the state of voting. But nevertheless, this is something that the Tesla bulls were very concerned about, that if Musk was not able to get approval for this compensation, concerns about him, taking his eye off the ball and potentially, devoting more time and resources to his other ventures, and he has many other, as we know, whether it's X or XAI. It's very much been top of mind for the big investors who are still huge believers in Musk. That if he were to step back in any way, shape, or form, it would be a big setback for the company.
Yeah, and to that point, you can see there Tesla up 5.5% in the pre-market because of that. So, Craig, if this is a Musk who has gotten his pay package approved, is this now an emboldened Elon Musk heading into this AGM and just for the rest of this year? And what does that actually look like to take that off the table, this issue that he's been grappling with?
Well, I think one of the big concerns is that, this has all been a sort of distraction that in the end, it hasn't necessarily been taken off the table, that this was a measure that really carried more sort of symbolic weight than legal weight. And Tesla acknowledges that actually in its proxy filing. So this is far from over. This is going to continue to play out in the courts. It may be the case that the company ultimately appeals this to the Delaware Supreme Court. But some procedures still have to sort of be taken care of before we get to that step. And all the while, we have seen signs that Tesla's underlying business, have not, particularly lit the world on fire. That the real concern has been this company relying on just a couple of models that do sell at high volumes, but have had some slip ups in terms of demand. And we don't necessarily have, confidence that, fresh product is waiting in the wings here.
Right. Craig, thank you so much. Bloomberg's Craig Trudell. I also want to get you a quick check on Broadcom shares this morning. They're up about 12.5%. The chipmaker's quality results topped Wall Street's estimates. It had a chunky demand for its AI product, one of the only themes that can give you a win in today's market if you're actually turning out results and margins from it. Let's bring in Bloomberg Intelligence's Matt Bloxham on this. So, okay, Matt, Broadcom, it doesn't produce AI chips like NVIDIA. Instead, it's some of the components. But we've seen really diverging companies when they talk about AI for a market that rewards them or punishes them. So what's behind the reward this time?
Yeah, so I think there's a couple of things going on here for Broadcom. It's important to remember that a lot of what they supply goes into data centers, and data centers are at the heart of this whole AI boom. And so with the kind of first wave of the AI excitements around, obviously, NVIDIA and the kind of chips that drive the AI technology. But as those platforms in data centers get more and more complex and sophisticated and become kind of little networks of their own, then the expectation is going to be a huge amount of demand for the kind of technology that Broadcom provides to make all of that data center infrastructure work properly. And so I think a lot of people are expecting that as we get into that second wave and these data center-based AI environments get more and more complex and bigger, that Broadcom's going to really benefit from that. And I guess as a kind of add-on to that, they acquired VMware, which is a really important software player in the whole kind of cloud environment. That's kind of giving them a kind of second wave of revenue growth in that area.
So potentially position themselves really well for this brave new world. Apple is also one of their top customers. I love that in their earnings call, they don't say Apple, but they'll say his North America customer or just some other kind of like vague thing that we all know, okay, you're talking about Apple. It's no secret what you're doing. How much of a difference does it make if we are about to get this AI-enabled upgrade cycle from Apple? What does that mean in turn for Broadcom?
Yeah, that's what I say. I think last year they inked a new multi-billion-dollar deal, and they're a key supplier of components into the iPhone, and yet the market seems to be getting more excited about a potential uptick in iPhone demand on the back of the kind of AI push that we heard about earlier in the week. So again, that's a kind of another leg, if you like, to the Broadcom growth story that may well kind of play out over the next 18 to 24 months if we do see that uptick in iPhone shipments come through.
Okay, exciting times. Matt, thank you very much. Bloomberg's Matt Bloxham there. Okay, coming up, we're going to get some more economic data today. We'll also hear from Secretary Yellen this afternoon. We've got it all covered for you here on Bloomberg in a beautiful morning in New York City.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep Green World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m. only on Bloomberg Television. Context changes everything.
This is your Bloomberg Brief. I'm Danny Berger in New York. Manus Cranny is out on assignment under the beautiful sun somewhere out there in the world. Okay, let's take a look at what's ahead today. We're going to get more eco data. U.S. PPI hits at 8:30 a.m. Eastern, along with another round of jobless claims. Then New York Fed President John Williams will be moderating a discussion with Treasury Secretary Janet Yellen. That happens 12 p.m. here in New York. And the G7, that is in full swing for the next 3 days in Fasano, Italy. We've just heard an agreement that they reached a $50 billion package of aid for Ukraine. Okay, let's look at your movers pre-market. Tesla jumping this morning more than 4.5%, just under 5%. Musk has said that shareholders are backing his pay initiative. That annual meeting is scheduled for the market close. He's kind of spoiled it a little bit by saying that. He also says that they've approved his measure to move their headquarters to Texas from Delaware. Finally, Dave & Buster's, that is dropping after the earnings. Remember that company, a blast from the past, down 10 1/3%. Truist Securities analysts citing stiff macro headwinds that are hurting performance while a turnaround is still in progress. Meanwhile, these overall markets, U.S. 10-year yields, little changed this morning. But over the past 2 days, it has been a roller coaster ride. You can say yields drop right after CPI. That little tick higher is the Fed. And now we are just treading water. So where do we go from here? Is it 2 cuts or 1? Surveillance. That'll discuss up ahead.
Names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is a Fed that focuses excessively on the past and doesn't want to signal much about what's ahead.
Central bankers don't shout mission accomplished.
They are very deliberative right now in terms of not getting too far ahead of themselves until the data comes to them.
The data is probably more important than the dots in this case.
This is still a Fed that is looking to cut rates, very supportive to financial markets. So I think this is a pretty good setup here for bonds and stocks.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
I'm definitely not alone. When I woke up this morning and thought this, I cannot believe it's only Thursday. How was it not like Friday afternoon, market close, 4:01, wrap it up and get to the weekend?
Let's just say that it was Friday afternoon after 8:30 a.m. Eastern yesterday, because that pretty much closed the books for a lot of people, even though Powell tried to walk it back a bit.
Head to the beach and start the summer already, for goodness sake. Live from New York City this morning. Good morning, good morning. Equity futures just about positive on the S&P 500. 3 consecutive days of all-time highs on the S&P 500. CPI, the main event yesterday at 8:30 Eastern time, coming in cooler than expected. And then we all walked away from the Federal Reserve kind of dazed and confused about the projections.
It seems as though they were burned by experience, sort of conditioned by recent events. And that's essentially what the Fed seems to be signaling. They're happy with the progress, but they're not willing to declare victory. They're concerned that maybe the first quarter was something other than just a blip, and they'd like a little bit more. The market took that and said, we don't buy it. We're going with CPI.
I've got a number of takeaways from that news conference. I think one for me, and we'll talk about this a little bit later, was on the labor market with Chairman Powell. We're trying to work out whether payrolls of 272,000 on Friday overstates the strength of the economy. He basically said it kind of does, that maybe that number on Friday overstates where things are.
He didn't even try to explain it. Let's just put it that way. He came out and someone asks, can you explain this? And he basically said, no, I cannot. It does seem like it is overstating things. And he used those words specifically at a time where he talked about how there's something off about the household survey and then what you get more broadly. That said, he didn't say it's wrong. He didn't try to cast any conspiracy theories that maybe some of the rest of us will, and just said, it's noisy. So we have to take it as it is and then move forward. Nonetheless, this is a Fed that a lot of people still think is firmly, potentially on the table in September, even if July is out of the picture.
At 8:29 yesterday, if I'd said to you that median dot would imply 1 cut for 24 and not 3, I think you would have said that was super, super hawkish. He really muddied the waters around that. We all had one question going into the news conference. Did they have this data before they gave those forecasts? And if they gave those forecasts and then got the data, did they have the opportunity to update the forecast? He said they had the opportunity to update them, but some people didn't take that opportunity to revise them. Now, does that mean that basically their outlook hasn't changed even with the print at 8:30? Or does that mean that the forecast they put out are now a little bit dated? Which one is it?
Some, most. I mean, honestly, first of all, the answer is he is highlighting how confused and kind of split apart this Federal Reserve Committee really is. To your point, some people did revise it. Most, I think he said, did not. So The question of what their motivation was, unclear. It also really is highlighted by the breakdown of the vote. I think we should go over that again.
Sure.
Because to me, it really highlights just how bifurcated this FOMC really is. 4 Fed officials see no rate cuts this year, according to the projections. That is shockingly hawkish based on what a lot of people are saying. It's very much in the Torsten Slot camp. That is up from 2 officials in the March projections. 7 see 1 cut. So that would be leaving us in the 1 cut category. But 8 see 2 cuts. So it's not as if this is a Federal Reserve committee that's not going to go at all if they do see some serious weakening. What does that leave you? With confusion. And basically the likes of Bob Michael saying, I'm in charge now, and I will dictate where yields should go based on supply and demand dynamics.
It's really, really finely balanced. I think just to try and make it somewhat simple, the former Fed Vice Chair, Richard Clarida, was on with the team a little bit earlier on Bloomberg TV. He said, on net, the Fed was hawkish. On net, on the day, it was a dovish day for markets. And I think that's the takeaway for markets. We closed at all-time highs in yesterday's session.
Just going off of CPI, you saw inflation come in at some of the lowest reads going back to 2021. This is material progress, and the market is taking that, and they're hearing the Fed's mess over here, and they're saying, okay, that's nice, but we'll look at CPI first.
Just want to flag some news for you just quickly before we move on. The G7 agreeing on how to tap frozen Russian assets to get $50 billion for Ukraine. Anne-Marie with some great breaking news, some details around that. We'll catch up with AMH in about 26 minutes' time. I was reminded of that because of people on vacation on the beach, you know, having a good time.
And you think she is?
I thought of Anne-Marie.
Yeah.
Immediately.
Well, you know, honestly, for all those who are feeling bad for her, that we're basically, you know, trolling her, she is trolling us so hard, sending us beautiful pictures, posting these magnificent vistas of beaches and saying, you know, it's tough life.
Eh?
So
small violins and all of that.
Yeah, very.
Okay, let's get to the scores. Equity futures on the S&P 500 shaping up as follows. On the S&P, record highs at a close once again yesterday, positive by 0.07% this morning. Yields a little bit lower, down a basis point, 430.43 on a 10-year, and the euro going nowhere, just about holding on to 108 at 108.03. Coming up, John Stolfus of Oppenheimer as U.S. stocks notch another record high. Former Kansas City Fed President Thomas Hoenig on a less restrictive Fed, and Colin Martin of Charles Schwab saying the peak in yields is behind us. We begin with our top story, the S&P 500 topping 5,400 for the first time in history, even as Fed officials predict just 1 rate cut before the end of the year. John Stolfus of Oppenheimer saying this: resilience is what's likely underpinning the economy's trajectory towards normalization. We believe the U.S. economy is likely mid-cycle rather than late cycle, as some suggest. John is with us for more. John, good morning, sir.
Good morning, John.
Another all-time high in the equity market. And I just want to frame your views coming into 24 because I think it's important to sing your praises because you are a modest man and won't do it yourself. You came into this year and you said, I'm constructive risk, I'm long the equity market, but it's not dependent on this Federal Reserve cutting interest rates. I don't think they will anytime soon. What did you see that was like your guiding light around the story so far this year?
I think what it really was when we look back at it, John, is the thought that Jerome Powell does not want to be remembered for blowing it on inflation and letting inflation come back in after cutting. And I think the Fed mostly feels that way when you hear the differences in the Fed speak. The mix where some not expecting any cuts, others expecting 1, 2, whatever it be. Those of us who lived through the 70s inflation never forgot it. And the failure of Arthur Burns and what necessitated draconian measures by Paul Volcker. And then a 15-year period, as I recall, of Alan Greenspan and a science project learning what the modern Fed would be like in terms of where rates would go. I think that memory is very much in Jerome Powell's mind.
Calling what the Fed will do is tough. Calling how the market will respond to it is sometimes even harder. You got step 1 right. You got step 2 right as well. Let's talk about step 2. Why did you believe that wouldn't be negative for equity markets?
Well, I very much remember when the 10-year was at around 9%. And I remember a Fed funds rate that was significantly higher, and I remember equities moving up. It was after I came into the market in 1983, so that was Volcker's second term, and I might have made a mistake. It may have been that the Fed funds rate was 9%. I don't quite recall. It's published in our pieces every week, but I can't remember everything. But what I will say is it depends if business can still grow revenues if they can still grow earnings, and if there's enough innovation around, things are changing for the positive. Business people will move on that, and the market will get a sense as a discount mechanism that stocks can move higher. I remember speaking with clients when they were enamored by 12% coupons on fixed income, and I was pitching equities. Okay, for diversification purposes, we could have a little bit of both, but it was the equities were just screaming out that they were undervalued relative to where we were headed.
Are they still screaming that out? I mean, we're pretty close to your year-end target.
I don't think they're quite screaming it out. I think equities are closer near term to being fully valued, but I think that our 5,500 target is likely to be exceeded probably in the next few days if we don't get some catalyst for the bears to move in and take us down 5 or 6% as they've done so frequently this year.
Some people have argued that this is a fragile rally. This is the 28th record high as of yesterday. We're still counting. But it wasn't led by small caps. It wasn't led by sort of a broadening out at all. It was led by big tech. In particular, it was led by NVIDIA, by Apple, which became the most valuable U.S. company out there, surpassing Microsoft once more. So do you view this as potentially a negative sign, that equal weight just keeps underperforming, even though the tailwind ostensibly was the potential for rate cuts?
Well, I've got to say, the thing about the big tech companies is that they're profitable, they've got a positive cash flow, and they're deeply embedded in our lives. Oppenheimer doesn't allow me to talk about individual companies because I manage money, but I can say, well, I can
AI
say,
chips.
AI chips are essential to where we're headed, and businesses are looking to invest in AI because they want to remain competitive, they want to be more efficient, and they want to be able to navigate tougher environments. If anything, today, people over the last 15, 16 years have been some of the toughest times. You know, the great financial crisis, the pandemic, the whole mess with the global supply chain, a move towards diversifying away from one country's centricity, dependency on the global supply chain, all this stuff. And it requires advanced logistics, all kinds of technology to navigate this. So, you know, the other side of it is, but I can say there is one company that we all know very well. If we brought out our cell phones, probably all the cell phones would be by that company. What did they do? They set it up so if you want the latest in AI, you have, if you don't have the phone that came out this year,
buy a new
the
one.
phone, you gotta. We're all tied to an upgrade cycle, whether we like it or not, irregardless of who's supplying our technology. And that makes tech very important, and not in an artificial sense, because it's both business and the consumer find it deeply embedded in their lives.
So you're bullish, Jensen, and bullish, Tim. I'll say that for you. You're overall constructive on this equity market. Now, I understand why. It's fairly convincing. We had an upside surprise on payrolls. We had a downside surprise on CPI, and a Fed willing to cut interest rates at a first sign of weakness. Sounds pretty constructive. My favorite question for you, what would change your mind? What would you need to see that would lead you to come on this program and say, John, change my mind, don't see it the same way, trim some risk?
It's what Barton Biggs would have called the bolt from the blue, the sock to the jaw, you know, the unexpected problem that emerges that would cause people, like in 22, when everybody just projected negatively overnight, not us, but that could sour sentiment near term or something really dramatically awful. But otherwise, where we're headed just looks like there are more positives to offset the challenges and the negatives that appear.
Yeah, well, we're not even halfway through the year, and we're, you know, basically a stone's throw from your year-end target. So barring some sort of cataclysmic event, how close are you to upgrading your year-end target?
Oh, I would say very close, but it's our discipline happens to be that unless the S&P closes at or above our target, we don't raise it because we don't want to jerk the clients around. You know, there's a lot of people will just, they'll upgrade and downgrade and they'll give two different targets and everything. We're pretty disciplined on our targets and fortunate that we've been fairly successful with them over the years.
You stay disciplined, John. It's great to see you.
Thank
you've had a fantastic year so far, and you've been working very hard. We appreciate it.
knocking on whatever this substance is.
I believe there's a little bit of wood in there. Buddy,
so knocking on wood.
Hopefully there is.
Okay.
John Stelfus of Oppenheimer. John, thank you. The equity market closing yesterday north of 5,400, 54.21, an all-time high on the S&P. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. G7 leaders have agreed on a plan to tap frozen Russian assets to provide Ukraine with $50 billion of fresh aid. That, according to people familiar. After months of discussion, the plan is set to win the backing of leaders who are currently at the summit in Italy this week. The structure of the loans would reportedly be based on the size of each of the individual economies. The nations would then give loans to Ukraine, and they would be repaid using the profits generated by the some $280 billion of blocked funds, most of which are immobilized in Europe. Let's get you a check on Broadcom this morning, surging 12% in the pre-market. They had quarterly results and forecasts that topped estimates, thanks to robust demand for AI products. Given that Broadcom makes components vital to data centers, they also announced a 10-for-1 stock split. Shares of Tesla, they're also up in the pre-market, just above 5%. CEO Elon Musk says that two key proposals to ratify, one, his pay package, and two, move their legal home from Texas to Delaware, are going to pass by a wide margin. Tesla's shareholder meeting is today at the company's headquarters in Austin. And that's your brief, John.
Hey, Danny. Thank you. More from Danny in about 30 minutes' time. Up next on the program, the Fed leaving its options open.
We think policy is restrictive. And we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy.
That conversation just around the corner, live from New York City this morning. Good morning.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Live from New York City, all the fireworks, the fun, the games, all yesterday at 8:30 Eastern Time. CPI cooler than expected, sending equities to an all-time high on the S&P 500 right now, adding just a little bit of weight to that by 0.04%. In the bond market, yields just about unchanged at 430.82. Under surveillance this morning, the Fed leaving its options open.
We think policy is restrictive. And we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that, you know, since we raised rates this far, we've always been pointing to cuts at a certain point. Not to eliminate the possibility of hikes, but, you know, no one has that as their base case. So no one on the committee does. But so that's, you know, that's how we think about it, and that's what we've been getting.
So here's the latest. The Fed penciling in a 1 rate cut this year from the previously expected 3. However, Powell keeping the door open for more as investors still bet on 2 in 2024. Have you got all that? For some clarity, Thomas Hoenig now joins us, the former Kansas City Fed president, known widely from Fed watchers as Mr. Dissent himself. Fantastic to catch up with you, sir. Thomas, I want your opinion on just how divided you think this committee actually is.
Well, I think it's divided. I don't know how much. It appears that it's pretty widely divided, perhaps. And I think that's because I've noticed inside, at least in their speeches and so forth, these members are talking more and more about their so-called long-run natural rate or the equilibrium rate and what that might be and how that might influence things. And I think there's a disagreement there. I think some, myself, if I were there, I would be included in this, think that the natural rate or the real equilibrium rate long-term has moved up substantially, closer to 2%. And if that's the case, with 5% inflation with 5% Fed funds rate and 3% inflation, you're about 2% real Fed funds rate equal to the long-term equilibrium rate, or R star, and therefore you're in a steady state. So you have a period where you're going to maintain a 3% inflation rate over time. And then there are others who think, no, that rate is still very low, and therefore we're restrictive. And I think that is still carrying the day, and I think the chairman must believe that as well. And so they're going to wait and see. But it's not terribly restrictive. Even the chairman knows that. And so it's a long-term kind of expectation that inflation will come down gradually over the next year or so.
There are a range of beliefs on the FOMC, and we can see that in this scattered dot plot. I'll share some of the details, Thomas, with our audience. Lisa did this a little bit earlier this morning. You've got the median dot signaling just 1 cut for 2024, but you go through the individuals in the dot plot. 4 policymakers saw no cuts this year, 7 looking for 1, 8 looking for 2. You were part of the evolution of the post-GFC communication apparatus at the Federal Reserve. Do you think it's had its day? Is this more harmful than it is helpful?
No, I don't think it's harmful. I mean, the fact that they are having this internal discussion and this uncertainty, I think the market should know about. You give them this very strong, confident, we know this is where it's going, and you mislead. So it is a very tenuous period. No one knows for sure, and this kind of reflects that. And I don't think that's necessarily bad, and it also means that they're probably not as coherent in their no change as some people would like it to be. But one thing is sure, the one thing they are agreeing, and you know it, is there are not going to be any rate increases barring a upside surprise. A huge increase in productivity, which is unlikely, a shock of inflation, which is at least unlikely. But on the downside, it's just a matter of when. Are we going to be there sooner or later? And okay, I know that, but I know which side the bias is on. They're going to ease eventually.
Thomas, it's when they begin the rate cutting cycle. It's not just when they make a cut. And this is what I thought was really interesting yesterday. It showed the same rate cutting cycle kind of telegraphed by the Federal Reserve, just pushed out maybe a quarter, just pushed out by a couple of months. Do you think that that is an error? That basically this is an economy, based on what you just said, where the Fed funds rate isn't that restrictive, and we can kind of continue here for a longer period of time, and maybe they're not going to hike rates, but in your view, maybe they shouldn't cut rates either?
Well, in my view, they are at a steady state, so they at least should not be cutting rates anytime soon, because right now we're at 3%. And if you look at it, we should stay in that range for some period of time, based on my estimate of the long-run equilibrium rate at 2%. And I think that is, that's on the margin. I mean, that means we're going to stay at 3% for a long period of time. And a lot of people in the market and elsewhere are very happy with that, and they would be fine with that going forward. I think that is the issue, because what would cause them to ease sooner is a banking problem, some kind of a negative shock, which is more likely than a positive shock. But in the meantime, they should at least be staying where they are and not projecting that we're going to lower rates another time this year. I think it's unlikely that they will, barring a shock.
You helped run the FDIC for many years. And you just talked about the potential for some sort of banking crisis or a banking shock. Mark Zandi of Moody's came on this week and said basically that's his big concern, that you are seeing cracks under the surface, particularly with smaller and regional banks where some of them are not going to survive. Do you agree? Do you think that that is a real risk, or do you think that that is overstated and just simply a number of firms that have a bunch of loans on their books that are underwater, they're going to have to work it out, but it's not systemic?
Well, I think the banking industry is more vulnerable than the Fed would like you to believe, and I understand. I mean, if I were the chairman, I'd be saying things are fine because you don't want to precipitate a problem in the banking industry. But when you look at the numbers of the industry, given the very significant increase in interest rates last year, they are struggling. Number one, you have very large hold-to-maturity unrealized losses in that book. And the idea there is that over time, that'll turn over and they'll get through that, take an earnings reduction, but they'll get through that. But on the other hand, on their loan portfolios, not just their commercial real estate, but some of their commercial industrial loans, those are also under very significant pressure given the rise in interest rates and all the repricing that has to go in the economy. So that makes the industry more vulnerable. And that means I think it would be very difficult for the Fed to increase interest rates right now because it would worsen that situation and perhaps bring it to the surface. And they need to, I'm sure they feel they need to avoid that. And that's why they won't be raising interest rates anytime soon because of that vulnerability, in part at least.
Thomas, this was a privilege. It's fantastic to catch up with you, sir, and hopefully we can do it again soon. Thomas Honig there, the former Kansas City Fed president, joining us live from Washington, D.C. on the Federal Reserve decision. If you're not familiar with dissent at the FOMC, that's because it's incredibly rare. For this man, it really wasn't at all. It was no, no, no to more QE, and I think there was a string of no's after that coming out of the financial crisis.
Very concerned about too big to fail. Very concerned about what kind of precedent you were setting in terms of incentivizing people to do bad things and then get bailed out afterwards. Question is, are we still seeing dissent on the FOMC? It's just is kind of masked under this veneer of sort of collective thought, because frankly, we keep going over that split. That is not exactly, all come together and sing kumbaya type of FOMC.
So you can remind me of this, okay? You can remind me of this, I promise you. No problem. I'm looking forward to the Fed speak, okay? Just am.
Good.
Just a couple of days of it. 2 weeks in, then you can start saying to me, John, you said you were looking forward to it, but a couple of days of it. I'm looking forward to it.
You get some today. At noon, you have John Williams, the New York Fed president, who's going to be interviewing Treasury Secretary Janet Yellen at the New York Economic Club. My guess is there won't be that much directly tied to monetary policy, but watch this space, because talk about the confluence of fiscal policy with monetary policy, and two people very much in position to talk about that.
Well, if there's some Q&A, I know what I would ask. I'd want to know, did you upgrade your forecast after you got the CPI print, and if you didn't, why didn't you?
Yeah.
I've got some questions about that. I think we all have. Coming up, we've got some questions for Anne-Marie, some fantastic reporting out of Italy, AMH of the G7 in just a moment. From New York, this is Bloomberg.
names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Quite a session yesterday, quite a session. I don't think we're going to top that today, that's for sure. Equity futures on the S&P 500, muted moves, up by 0.07%. On the NASDAQ 100, up by 0.6. What are you laughing at?
Are you daring someone to say, hold my beer?
No.
We're not going to up this again.
Okay.
We're not going to have a 29th record high. Good luck.
Give me the camera back. Let me start again. All right. Just to clarify, based on the schedule, I don't think you're going to have a session like that again.
Okay, fair point. Fair
There's
point.
no
That was
CPI,
good.
8:30.
Okay.
We got jobless claims. There's no Fed decision this afternoon. I'm not trying to tempt
That was
anything.
good.
All right.
I know, but that was good. That was
Clean
good.
that up. It's too early for this. Switch out the board and get to the bond market. 2-year, 10-year, 30-year. Looks like this. 2-year yields unchanged. 475.16 on a 10-year. 430.82. Some wild swings following CPI yesterday. And then if you just had a look at a chart of, let's say, the 2-year. We had this big move lower on a 2-year yield at 8.30, and then Lisa just unwound a lot of that as the session progressed. The Fed decision came out, we got the projections, a bit more hawkish than expected, and then after that, Chairman Powell starts talking, and we want to know, like, okay, did you see CPI, and did you put that in the forecast? And he basically said, yes, some of us did, but most of us didn't, and yields went up a little bit more.
Basically, it didn't have the same kind of dovish tilt that a lot of people were expecting, especially after the victorious-seeming CPI print that came in at the lowest going back to August of 2021. The issue is, it couldn't really, his sort of reticence to embrace it couldn't outdo what we saw for CPI because it frankly was confusing. There was a sort of hawkish tilt, maybe, under the hood, perhaps, depending on different members, but there wasn't a lot of conviction. We all walked away feeling like the Fed was confused and ready to respond to any kind of weakening in the labor market.
I'm not sure they're confused, but I certainly was. After some of those explanations, I want to turn to the euro. 108.52 was a session high yesterday. We had a lot of euro strength and much more so dollar weakness in yesterday's session. We unwound a lot of that as well, actually closed the session out at about 108.09, and that's basically where we are at the moment at 108.08. That currency pair is totally unchanged. Under events this morning, want to get you some top stories. Here's one for you. Manhattan rents slipping for the month of May. According to data by Miller Samuel and Douglas Elliman Real Estate, rents were down 3.3% year over year. The median rent coming in at $42.50 per month. New leases were up 41% from a year earlier, but inventory also climbing about 28%. So volume's up, inventory's up, and things are starting to stabilize just a little bit.
And basically what you have from Jonathan Miller over at Miller Samuel is that this isn't the beginning of some sort of trough or bottoming out or some sort of massive decline. It's just sort of a market that's moving sideways after a lot of price appreciation. The volume aspect is interesting. This highlights all the people who are living in their apartments, renting because they can't buy, who get slapped with some sort of increase in their rent prices and say, no thanks, and they look elsewhere. This is basically that pushback, and they're able to look elsewhere because of the leasing volumes, maybe because you finally have some of those empty apartments being unleashed into the market. Either way, this actually speaks to a more healthy market. with an actual activity pipeline that we haven't seen in quite a while.
Clip this video, show it to your landlord. Rents aren't going up in Manhattan. I can't get excited about 4250 though. Can you? It's so expensive. Isn't this part of the broader inflation conversation, though, that we can sit here and say prices are flat on Manhattan rents, and for most people, they're like, that's meaningless to me. They're 4250.
That's the reason why a lot of people say it'll just take time, because this is such high values relative to where they were, say, 3 years ago, that it's still sticker shock. And that's going to be a perpetual problem politically and certainly for the Fed in terms of messaging.
Let's get you some politics and some messaging too. The former president, Donald Trump, has a busy day in Washington today. Trump will meet with Republican lawmakers on Capitol Hill this morning. Then Trump is set to meet with some Wall Street CEOs, including JP Morgan's Jamie Dimon, Citi's Jane Fraser, Bank of America's Brian Moynihan, and he's catching up with Apple's CEO, Tim Cook. This all according to people familiar with the event hosted by the Business Roundtable. That's going to be an interesting day ahead for the former president and for those individuals.
How much things have changed from, say, 6 months ago? I mean, when you think about it, there was a time when a lot of these business leaders said they were never Trumpers. They were going to stay away from the election. They were not going to necessarily, they're not never Trumpers, but they weren't going to necessarily get involved in the election that seemed a little toxic to them. Now they will engage no matter what, even with the sort of verdict hanging over the former president and the whole concept of felony, et cetera. It doesn't really faze executives, considering the fact that he still very well could be president, and they still want an in, given some of the policy shifts that are coming down the pike.
I think most of those individuals are incredibly pragmatic, and we often refer to Tim Cook as like the diplomat of technology, because he's managed to avoid a lot of these divisions between the United States and China. So for those individuals, I'm not surprised. For some others, for some people who have come out on the record and been like, can never work with the guy, I'd be more surprised with them. These individuals, I'm not so sure.
I'm curious what they want to know from him. I'm curious what the conversation is like, how much he basically is giving them a sense of what policy is going to be, or whether it's basically a meet and greet and get your face seen and basically say, we're on your side. We didn't actually, drag your name through the mud, so don't be mean to us.
Let's see. Look, I think Trump, at the end of the day, with people like this, incredibly impressionable. Don't you agree?
I would agree.
Yeah.
Especially given the fact that potentially they're donors. Let's watch that space. And two, potentially, if he's very sensitive to the equity market, Tim Cook accounts for a significant portion of the equity market. So, I mean, ostensibly, he might be somewhat deferential.
He's a Dow kind of guy, though, not an S&P kind of guy.
Says who? Is this breaking news?
He likes to quote the Dow a lot. He's a Dow kind of guy.
Is that true?
The former president's a Dow kind of guy.
Really?
He'd quote the Dow. Absolutely.
You think so?
Oh, yeah.
Okay, you heard it here first, so maybe we should index the Dow.
Strikes me as a Dow kind of guy.
What is a Dow kind of guy?
80s New York is a Dow kind of guy.
Okay.
Yeah, 80s New York.
So then why don't we have an index? So if he becomes president again, we should have the Dow being the benchmark index for most ETFs out there.
The real test is when you get an all-time high, what do you quote? And he would quote the Dow.
Okay.
No doubt about it, because the Dow connects with a lot of the electorate.
So you're going to have a lot of GE.
The S&P, it's like Wall Street.
Okay, so you're going to have a lot of GE, a lot of Caterpillar.
Yeah, something like that.
Yeah.
Sure.
Okay.
There you go. All right, let's get to this. Some real news. That's not actual news, obviously. Okay, too much. Didn't sleep last night, you can tell. G7 leaders agreeing to a deal to provide $50 billion of new aid to Ukraine, according to Bloomberg's reporting. The agreement would hand out loans to Ukraine, which will be repaid by tapping about $280 billion in frozen Russian assets. Anne-Marie, working hard to break that story for you. She joins us now from the G7 summit in Italy. AMH, what do we need to know?
Well, they've reached this deal, Jonathan, which they've worked on literally for months. The United States wanted to get this over the finish line. What they really wanted to do is that these assets, these frozen immobilized assets that are sitting in Europe, about $300 billion worth, are collecting interest on these securities. And instead of just giving the interest that are accruing year by year, they wanted to front load it. Basically, a loan, a line of liquidity to Ukraine, especially before critical elections. It's a way of election proofing some of the financing that they feel Ukraine needs, and they've been able to come to an agreement. Some technical work will still need to be done after the G7, but given the fact that they have this agreement, they want those funds to reach Ukraine by the end of the year. It'll be about approximately $50 billion worth, with a number of countries willing to sign up. Of course, the issue is that they need to make sure that at some point they are remained they get to be paid whole. So that is either through the payments on these interests in the future, or if there was some sort of peace negotiation at some point, if this were to end, then Russia would have to pay reparations for that money. So that's where the agreement is right now. And I would say that this was one of the biggest deliverables the U.S. wanted to get. They're going to have it, and they're going to be able to talk about it alongside Volodymyr Zelensky today when President Biden delivers a press conference with him.
The first point you made, I think, is the most important point. The fact that all of this now will be front-loaded, because as we know, the Europeans have already agreed to provide Ukraine the profits twice a year, anywhere between 3 and 5 billion. What they're doing now is front-loading it all to avoid what might happen in the future. Take a look at the picture at the G7. Anne-Marie, I think this is really instructive. You go through the individuals here. Macron, weak. The Biden presidency, hanging by a thread going into November. Sunak, I can't even describe how bad the polls are for Rishi Sunak in the UK. Scholz, certainly not Angela Merkel when it comes to the international stage. As for Trudeau, I'll save what I think of his prospects going forward from here. AMH, one by one, it screams weakness for the year ahead. How important was it to do this now, given what the next 12 months could hold?
This was basically the closing argument for many leaders, negotiators in the room. We have to do this now because the upcoming elections in these countries, and most importantly in the United States, if you're a European leader, you're sitting around this table and you think November's a coin toss, you have to sign up for this agreement now if you want to make sure that Ukraine has funds to draw on as they try to, one, fight Russia in this war, and also when it comes to reconstruction. These leaders, Jonathan, are walking into the luxury resort of Borgo Egnazia today, weakened and embattled at home, dealing with an electorate that pretty much has said that we don't always agree with you as leadership. Why it was so shocking this morning when Jake Sullivan briefed us reporters on the ground saying that Biden is entering this fourth G7, that with a G7 that is more aligned than ever. Maybe these world leaders around the table are aligned with their vision for the future, but not all of them are aligned with their electorate back home. And you named all of them, except for one, Giorgia Meloni. This is a coronation, this G7, basically, they're coming down to Puglia to kiss the ring of a brand new European leader. And even the opposition party in Italy and even left-leaning civil servants that don't agree with her politics, they say, ma è brava, but she's good. And that's where Europe is today.
Anne-Marie, can you give us a sense, based on that dynamic, how much are they kissing Meloni's ring, and how much are they setting up a landscape to sort of surpass the wave of whoever gets voted in next? In other words, how much are they trying to sort of immunize the whole project that they've been working on of the international order of yore in order to go forward with things like Ukraine, with things like some of these steps against Russia, against China?
Well, they're trying to come to agreements on a number of these issues, but even within the G7, you can see there's large gaps when it comes to things like China. The United States is putting 100% tariff wall up when it comes to Chinese electric vehicles, which, by the way, there's not a single Chinese EV in the United States right now, while in Europe, they're taking a very nuanced approach. 17.4% say for one Chinese EV maker, as high as 45% for another. And this has a lot of concern with different members within the European Union and around the G7 table. Say Olaf Scholz. They begrudgingly are signing up for this. He was just at an Opel car manufacturer talking about the fact that we should not have trade restrictions. It makes everything more expensive, people more poor, and they're just going to reciprocate it on the other end for our foreign companies. So it's challenging, but that is why it is so important that they were able to, in their collective mind, get to this at least understanding when it came to the Russian assets, because they don't know what's going to happen in the future in a number in their countries. If you think the U.S. election is a coin toss, you think Rishi Sunak potentially is out of the job in exactly 3 weeks' time. Macron had to come out and say he's not resigning after he had to call snap elections because of the huge blow he was shown over the weekend for the European parliamentary elections. You can see that it's not so much that Meloni is moving towards them. I think they're trying to move into the direction of Giorgia Meloni, especially especially those who really doubted her when she came to power.
So what's left at this G7 summit now that we've had the Ukrainian announcement and basically we've understood that shift in power?
Well, the one thing is going to see some of the details potentially Biden's going to outline today when he stands alongside Zelensky when it comes to this bilateral security agreement they are talking about. We do know that the United States sent another Patriot missile system to Ukraine. Some of the details regarding that. This is another example of trying to election-proof a policy, have this security agreement in place before the U.S. election. Now, it's not a treaty, so a future president can pull out of it, but you can see some of these ideas on the margins have to do with this overreaching theme of trying to set up the rest of the year in case these leaders are out of power. I would also note something really interesting happening on the sidelines today, of course, is going to be this infrastructure summit. The United States has put up some $60 billion when it comes to global infrastructure around the world for middle and lower income countries. You have Larry Fink and Satya Nadella here alongside G7 partners talking about that critical infrastructure. What they're not going to say out loud, but I think is very obvious for anyone who follows these stories, at this is clearly their pitch to the global south and countries in Africa to do business with the West, and please do not do business with China.
MH, fantastic work. We'll touch base with you again in about 60 minutes' time. Anne-Marie on the ground in the south of Italy for the G7. Headed up by Georgia Maloney. Equity futures on the S&P 500, just about positive on the S&P. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Apple isn't paying OpenAI to use its chatbot. Apple believes that promoting ChatGPT to its users is of equal or greater than monetary payments, according to people familiar. The iPhone maker revealed a partnership with OpenAI during its Worldwide Developers Conference this week and said that ChatGPT will be offered for free on Apple's products. Their deal isn't exclusive either with OpenAI, and the company is already discussing offering Google's Gemini chatbot as another option. The list of the wealthiest people in the world just got an update in a big way. Larry Ellison of Oracle saw his fortune jump $14 billion on Wednesday. His company had just reported enormous demand for its cloud infrastructure. It's Ellison's biggest one-day increase ever, and it makes him the world's 7th richest person. Oracle is expanding its cloud unit to compete with major players like Alphabet as demand surges for capacity to support AI. Netflix says that it will air a live hot dog eating competition on Labor Day. The main combatants will be Joey Chestnut taking on rival Takaru Kobayashi. The announcement comes a day after Chestnut was banned from the annual July 4th Nathan's famous hot dog eating contest in Coney Island. It's because he had signed a marketing deal with Impossible Foods, which makes plant-based food and a meatless hot dog. And that deal apparently broke certain hot dog exclusivity provisions. And that's your brief, John.
Hey, Danny, thank you. As Danny's telling us about that story, what did you say? This is very controversial at home.
Oh, yeah. Oh, yeah. There's basically like, you know, is it even going to be a hot dog eating contest without Joey Chestnut? And Joey Chestnut's going to basically, what are we going to have, like a, you know, beyond meat kind of hot dog eating contest that Joey Chestnut's going to be like,
Shouldn't this be open to vegans?
Well, I mean, right.
Shouldn't exclude, right?
Exactly.
We want an inclusive hot dog eating contest, don't we?
Do you know they work out really hard? They need really good stomach muscles to really like compact it in there.
Don't work out.
No, I'm serious. They do. Actually, this is point of big analysis.
Okay, you tell me more about this in a moment. Up next on the program, the market taking control.
This is a confused Fed. What that tells me is the bond market is in the hands of people like me. I want to be concentrated in the front end of the curve, and I like credit because everything's telling me we're gliding into a soft landing.
Bob Michael's in charge. We'll talk more about that next from New York. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Take it back. Ripped.
Totally.
Absolutely shredded.
Kobayashi.
Didn't realise.
Yeah.
Didn't know that was a thing.
10-pack.
Why'd you need that to eat hot dogs?
You know, I don't know the mechanics of it.
Okay, just
I'm not
wondering.
an expert in eating contests.
I'm just
but
wondering, does he happen to be ripped and he also does the hot dog eating contest, or do you need to be ripped to do the other?
There was a time when I actually looked into this because I was
Sure, I believe
very
that.
curious about the obsession, and it sort of increases the stamina, and to be able to sort of compress it in your stomach and keep going. I don't think we really need to be doing this because people are eating breakfast, so we'll leave it there.
Okay, let's leave that there. That's impressive. All right, I mean, kinda. Equities on the S&P 500 look like this, positive by 0.06%. The bond market pretty stable. Yield on a 10-year, 430.82. Under surveillance this morning, the market taking control.
This is a confused Fed. What that tells me is the bond market is in the hands of people like me. I don't know what the Fed's thinking. I don't know what they're looking at. I don't know what they're going to do. All I know is current levels. I want to be somewhere around neutral. I want to be concentrated in the front end of the curve. And I like credit because everything's telling me we're gliding into a soft landing.
So here's the latest. Treasury yields holding steady after a bond rally sparked by cooling inflation. Even as Fed Chair Jay Powell of the committee project just one rate cut this year, it is by a very, very slim margin. Colin Martin of Charles Schwab writing this. Yields are likely to stay elevated until the timing of the rate cuts seem more likely. There's room for the 10-year yield to drift higher, but we maintain that the peak is behind us. As long as the next move by the Fed is a cut, then the 10-year should stay below 5% and the yield curve should remain inverted. Colin joins us now for more. Colin, great to catch up with you, buddy, as always. I just want to